Okay, so hello everyone. Good morning, good afternoon, or good evening, depending on where in the world you are catching me from. It's great to see all of you here today, and welcome to Retail Rebellion. Welcome to my webinar. And if you can hear me, you can see my slides. Let me know in the chat box and let me know where you're from. Okay, so I see a lot of people in the chat. I think about 5,000. Barcelona, Portugal, Singapore, Penang, Bishan, Sydney, Canada. A lot from the US. I see LA, I see Chicago, I see Philippines, I see KL, I see New York, I see Bahamas, Oklahoma, I see Austin, and well, too many to mention, but wonderful to have all of you here today. I believe some of you are here because you want to create another source of income for yourself, trading the financial markets, whether from home or anywhere in the world. And I believe that many of you are here because you want to grow your savings at a much higher return so that you can build your wealth a lot faster and you can achieve financial freedom, financial security in the near future. Correct? Great. So today I'm going to share with you exactly what it takes and what you need to do to achieve consistent profits from your investments in a stress-free, low-risk way. How many of you is important to invest in a stress-free way? I don't know about you, but to me, that's one of the most important things. I want to sleep well at night, right? And even more importantly, how do you build sustainable wealth over the long run so that you don't just make profits in the short term, but you keep those profits and keep compounding your wealth in the long run. Yeah. I'm also going to show you the exact methods that I use every day to manage my own personal investments, my own portfolio, which has just recently crossed the $19 million mark. Well, Singapore dollars, right? In US dollars, it's about close to 15 million. And how I managed to achieve double-digit returns despite market crashes and recessions and pandemic, and how you can do it. You know, how you can also build a multi-million dollar net worth, even starting on an average income. So there's a lot to learn today. Take lots of notes, and if you have questions, you can post your questions, and I'll do my best to answer as many as possible during the Q&A session at the end of the webinar. So stick all the way to the end for the Q&A session. Also take advantage of the big, massive discounts that we have of our mentorship courses and our playbooks and our software and stuff like that. It's like up to, if I'm not wrong, 60% discount. And I know many of you have been waiting many months for this special window to grab our courses and playbooks. So take advantage of it. I will explain the offer more at the end of the webinar, right? So if you guys are ready, let's get going. Are you guys ready? Okay, yes, wonderful. Now, first of all, how many of you here are retail investors? I would imagine that most of you are retail investors. If you invest your own money and you're investing less than $30 million, you're probably a retail investor, right? And but any institutional investors around? There are always quite a number that attend my class. Fund managers, bank traders, usually a few $100 million they invest in the market. It's not their own money, they invest other people's money, right? And if you're here, I know you are, hope you don't get too offended today, all right? So for many, many years, the retail investor has been known as what? They've been known as the dumb money, right? The dumb money. Why? Because they are thought to have very little knowledge, no experience, and they tend to get excited and buy at the top and panic when the market drops and sell at the bottom. And in the end, most of them always lose money. That's why they're the dumb money, right? And the institutional investors are known as the smart money because these are the guys with all the knowledge, all the experience, with millions of dollars worth of resources, of financial data, of software. And they make all the best decisions, right? They buy at the bottom, they sell at the top, they make all the money. So what are you told as a retail investor? You can't beat the professionals. They're the smart money or the dumb money. You should give them your money to invest it for you, right? That's what we're told, right? And this happened for many, many years. But here's something interesting. In the last 6 years especially, there's been a huge shift. There's been a huge revolution. Okay, in fact, if you have read some recent articles, On Bloomberg, they actually admitted it. They said that smart money loses to the retail crowd that bet on the stock rebound. This happened in the last three major rebounds. I'll talk about it more later on. Another article here that says retail stock in market investors are no longer the dumb money. They are not the stupid. They are no longer dumb anymore, right? Retail stock market investors have become significantly smarter in recent years. Gone are the days of them buying high and selling low. So now what has happened is I call this the retail rebellion, right? The retail revolution, because now there's a big change that the institutional investor has now become the dumb money, stupid, right? And the retail, of course, not all of them, right? But many of them, like my students and myself, right? We become the smart money, right? Because in the last few years, it's found that many of the retail investors have outperformed the institutional investors, that they've made a lot of money. Well, a lot of the institutional investors, the fund managers, the bank traders have lost a lot of money in the last few years. Now, my question to you is, why? How has this happened? This reminds me of that show, Planet of the Apes. You guys watch Planet of the Apes, right? Where there's this big switch and suddenly the apes became smart, apes strong together, right? And the humans they became stupid, right? It is this huge change. So why has this happened? Why do you think so? Why do you think that this big change has happened in the last 6 years? A few reasons is because very recently, because of the internet, because of online learning, many retail investors now have the knowledge. In fact, they have got more knowledge than the institutional investors, many of them. And I'm very proud to say I've trained many of them. Okay. But the second reason is this. In the past, the institutional investors, they were the only ones who had access to the necessary financial data and software to find the right stocks, to analyze the right stocks. And in the past, you needed to spend thousands of dollars a month to get like the Bloomberg terminal to analyze stocks. And the retail investor didn't have access to all this software. But now, because of technology and because of AI, retail investors with just a few $100s a year, they can get access to the most powerful stock analysis software. And the most recent one that was released is called Stock Oracle, which I'm using every single day. Stock Oracle allows you to analyze any stock within seconds. So now it's what's the word for it? The retail investor and the institutional investor, they have got that same competitive edge. And that's why the retail are beating the institutional investors. So let me show you some specific examples. Okay, some specific examples. So like I said, in the last 6 years, many, again, of course, not all, okay, but many of the Wall Street professionals were dead wrong. And they missed the last three major bull markets. So what were the last three major bull markets? The first one happened after the COVID crash. You guys remember in 2020, we had a big crash because of the COVID-19. And at that time, what were the news articles? Can you see this, by the way, at the bottom? Is it too small? Or can you guys read this? Just to check. Can you read these three headlines from the news? You can? Great. So what's the first one say? The first one was saying from Goldman Sachs, one of the top investment banks. They said Goldman Sachs warns the S&P 500 might not bottom until 2,000 points, which was a lot lower. Okay. And then the chief of the International Monetary Fund, the IMF chief, said the pandemic will unleash the worst recession since the Great Depression. Oh my God, we're gonna die. And Jim Cramer, this professional from CNBC, he said, I'm convinced there'll be more selling. So many of these professional investors, fund managers, what did they do at the bottom here? What did they do? They sold all their stock, right? They went underweight stocks and they kept a lot of cash because they feared we're gonna go low. It's gonna be a depression. And in fact, a lot of them, they shorted the market. But what did a lot of retail investors do? They were buying stocks. How many of you were following me at the time? And I had a whole video telling people I was buying stocks and I told people that we're gonna rebound. How many of you watched that video? The Coke bottle where I sprayed the Coke bottle. Do you guys watch that one? right? So that was right at the bottom. And sure enough, the market went up. Hallelujah. The market went 118%. And all the professionals were like, oh, did this happen, right? And the retail investors were like, yeah, right? So, and then in 2022, we had another bear market because the Fed raised interest rates aggressively because of inflation. And at the end of 2022, what did all the professionals tell you? They said 2023 will be worse. We're going to have a recession in 2023 because of the Fed raising interest rates. So you can read this. It says, why a global recession is inevitable in 2023. This was from The Economist. And then the stock market will fall 25% when the US recession hits in mid 2023, says Deutsche Bank, the smart money. And stocks are poised to hit new lows a survey of investors show. So again, what did many professionals do at this point of time? They shorted the market, they went out of the market, but retail, we were buying, right? And then hallelujah, went up again. Okay. And this year, same thing happened. In March and April, we had Trump, who came up with all his tariffs. Remember that? And the market dropped 20%. And a lot of professionals say, we're in a bear market. Now, I was one of the few people on YouTube who said, no, there's no bear market. It's a bull market. You're nuts. I said, no, all right? So Jim Cramer warns Black Monday market crash worse than 1987 collapse. Bank of America, the smart money, they say short the S&P 500. We're going to die. Morgan Stanley said investors should brace for another 7 to 8% drop in the S&P 500. What did the professionals do? They shorted the market, they went out of the market, and hallelujah, the market's up over 30% and still going higher. Retail made a lot of money. A lot of the retail investors, myself, my students, we made double-digit returns. Many of my students have made hundreds of thousands of dollars. Some of them have made a few $1,000,000 in the last 6 years alone. Okay. And these were all the articles if you read. So in the 2020, 2021 bull market, by the way, this was actually an academic research paper. It says active mutual funds underperform their passive benchmarks during the COVID-19 crisis. Now, does anyone know what is the meaning of passive benchmarks? What does passive benchmark mean? It means the index. It means the S&P 500. So most of the mutual funds, they couldn't beat the index in 2020, 2021 because they got out of the market. They shorted the market, right? And you guys heard of Ray Dalio? Ray Dalio keeps telling us, we're going to die. The US debt is going to explode. We're going to die, right? Now, he was the founder and CEO of the world's biggest hedge fund called Bridgewater. And now, of course, he's retired. And what happened to Bridgewater, right? Bridgewater lost $12 billion in 2020. But he's still the best performing hedge fund manager. Now think about it. Imagine you lost $12 billion in 2020 and you're still the best fund manager. Then how about the rest? How about the rest? Okay. His pure alpha fund drops 8% in 2020. And then in 2023, 2024 bull market, hedge funds lost 43 billion. They lost 43 billion trying to short the market as the S&P iced its best month in over a year. And hedge funds got trampled by the bull market in 2024. And this year, same thing. Hedge funds have the worst start to a year on record. I had one of the best starts. My portfolio is one of the best this year, right? They are down about 4% this year. Hedge funds miss out on the US equities rally, but suffer smaller losses in volatile 2 days. By the way, is this anything new? The fact that these professional fund managers, they can't beat the market, is it anything new? It's not new, okay? Some of you have attended my past webinars know that for many, many years, most of them can't beat the index. They can't beat the market. So you can see from this table over here that over a 1 year period, in 1 year, what percentage of fund managers underperform the benchmark? Again, what does the benchmark mean? Benchmark means the index. Okay, it means the index, like the S&P 500 index. You can see that in 1 year, roughly about 50%, about half the fund managers, they can't beat the index. But over the long term, over 10 years, 15 years, 20 years, you can see over here, can you see the numbers? About 90% of the professional fund managers, they can't beat the index. That is crazy. That is shocking. But this is the reality. So what does this tell you? What does this tell you? This tells you that if you just buy the index, like the S&P 500, by the way, can you guys buy the index easily? Can all of us buy the S&P 500 index? Yeah, we can buy it through an ETF, right? If you buy the S&P 500 index ETF, you are able to beat 90% of the professional investors. That's it, right? So let me just show you, for example. So this is the S&P 500 ETF, and you can buy it very easily through any stockbroker. In fact, you can even use your CPF money to buy as well. Nowadays, they allow you to use CPF to buy the S&P 500 index through some of the funds, right? But I buy the ETF, okay? So there are many ETFs that are managed by different fund management companies. Like you've got SPY, you've got VOO, you've got another one called the CSPX. So there are many of them, okay, managed by different people. Now, in my investment courses, I'll go into detail the difference between these different ETFs, different management fees, but more or less they're pretty much the same. Okay, so like I said, if you just buy this ETF, you will outperform 90% of professional fund managers. So take a look at this chart, and you can see that over the last 20 years, the S&P 500. By the way, what does it mean when you buy the S&P 500 ETF? What does it mean? What are you actually buying? When you buy the S&P 500, what are you actually buying? You are buying the 500 biggest companies in the US market. Understand? You're buying a piece of Apple, a piece of Intel, a piece of McDonald's, a piece of Visa, a piece of Walmart. You're buying a piece of the 500 biggest companies in the US market. Now, to give you a rough example, in the US market, there are over 10,000 stocks of companies. Okay, there are over 10,000 stocks that you can buy. But out of the 10,000, they select the 500 biggest companies to represent all the companies. It's kind of like the members of Congress or the members of parliament that have been selected to represent all the people. So again, in these 500 companies, you have got Microsoft, Cisco, Intel, Apple, Walmart, Johnson & Johnson, Coca-Cola, Pepsi, right? 500 biggest companies. If you add the price together, you will get the S&P 500 index. Does this make sense, guys? By the way, let me ask you this question. Do you think all the 500 companies are great companies? Like they're all very profitable? Yes or no? No. So you have to understand that within these 500 biggest companies, some of them are very profitable, but some of them are not profitable. Some of them are lousy companies. So you've got good, the bad, and the ugly. So for example, Intel is not profitable, but Intel is still in the S&P 500. Okay, and you've got a lot of other lousy companies in the S&P 500. So when you buy the S&P 500, it's like you're buying a music album. You know, in the old days, we used to buy music albums, and in the music album, you have got some of the hit singles, but you also have got average songs and some of them lousy songs, but they're all in the album. You buy all 500 together, right? The good and the bad all mixed up together. So take a look at this. In the last 20 years, if you just held on to the 500 biggest companies, the good, the bad, the ugly, you'd have gained 670% growth in your savings. Okay. If you annualize it, that's 10.75% annual return. Your money is growing at about 10% a year. And this is despite the big ups and downs. So despite holding through the great financial crisis in 0809 and another crash here, another crash here, another crash here, another crash here, COVID 2020 crash, 2022 crash, trade war. So despite all the ups and downs, your money is growing at 10.75%. Now, this is over the last 20 years. How about over the last 10 years? Okay. Oh, yeah, Intel was just kicked out, right? Thank you, Farah, for reminding me. They were just kicked out, replaced. Yeah. And in the last 10 years, you can see that the S&P 500 gained 221%. If you annualize it, it's about 13.34% per year. Okay. And again, this is despite the crashes, despite holding through the big ups and downs. And there was a crash in 2015, 2016, crash in 2018, crash 2019, big crash in 2020, crash 2022, crash in 2020. Well, this was a small dip actually, right? And then crash, crash. And you get 13.34%. Okay. So what does it tell you? It tells you that if you just simply buy the index ETF without timing the market, just hold it through the ups and downs, close your eyes, hold through the ups and downs, you're getting between 10.75% to 13.34% a year. Now, is that good? Is that good? That's not bad given the fact that you don't have to pick any stocks, that you don't have to use your brain. Any idiot can do it. Any idiot. So I call this the idiot's way of investing. So if you're a complete idiot, you should still beat 90% of the professional fund managers, even as an idiot. Okay? And get between 10.7% and 13%, which let's say we take an average of 12%. Now, some of you may say, but Adam, 12% return is not exciting, right? True, but if you do this consistently, let me give you some numbers here. The average person in the developed country makes about $6,000 a month. I'm sure some of you make more than that, but take an average, right? Now, if you just save 10% of your monthly income, now what's 10% of 6,000? What's 10% of 6,000? $600, okay? So think about it, right? If you just invest $600 a month, you buy the S&P 500, you close your eyes through the ups and downs without using your brain, and your money is growing at about 12% on average. That means that in 25 years, so imagine if you're now in your 40s, okay, and you're going to retire in about 20, 25 years, your money would grow to $1.075 million just at a 12% return. If you're now in your 30s and you start doing this now every month, just put in $600, $600, $600, and it's growing at 12% without using any brain, then by the time you retire in 30 years, you're going to have about close to $2 million. If you're now in your 20s, and you start doing this now, by the time you retire in 40 years, you're going to have about close to $3 to $4 million. Okay, so it's not too bad. At least by the time you retire, you will at least have $1 to $2 million. Yeah. Now, but some people say, but Adam, I don't want to wait 25 years to get a 1 million. It's too long. I'll be too old. I can't enjoy. Okay, I want to reach that 1 million or that 2 million a lot faster in 10 years or less. So let me ask you this question. Is that possible? Is it possible for you to accelerate this result? So you don't wait 25 years to hit a million or 2 million. You can do it much faster in 10 years or less. Is that possible? Yes or no? Yes. How? How? How do you get there faster? There are two ways. Number one, save more money. Okay? Put more in. Number two, you must achieve a higher return. So instead of getting 12% return a year, you must aim to double that. Okay? To get maybe like 15% return or 20% return or 24% return. And to get a higher return, you must be able to beat the index. But to beat the index, you got to use your brain. You have to learn how to pick the most profitable companies. You have to know exactly when to buy, when to sell. And for that, you need to be educated. You need to be trained. You don't have to be trained by me. You can go and learn from someone else. I don't really care. But if you want to learn from me, that's what I do. I teach people how to beat the market consistently because that's what my students do, been beating the market both in the short term and the long term. All right. Okay, let's move on. So, what is the first myth that Wall Street has perpetuated for many, many years? The myth is that professional investors are smarter than you, so let them manage your money or follow what they do. Listen to their advice. Now, by now, you guys know that this is complete what? This is complete what? It is complete bullshit, right? So, what's the reality? The reality is the majority of professional investors themselves, 90% of them, they can't beat the market. They can't even get 12%. They can't even get 12%. Okay. Now, there are some very good fund managers. There are some very good ones, but very rare. I know some of them, by the way. Some of them are my good friends, and some of them attended my class. That's why they're so good, right? And one of the legendary fund managers, his name is Peter Lynch. And he said the smart money isn't so smart, and the dumb money isn't so dumb as it thinks. The dumb money is only dumb when it listens to the smart money. And this is from Peter Lynch himself. So he himself admits that if you listen to the professionals, you become more stupid. Okay. And another myth, they tell you if professional investors cannot beat the market with all their knowledge, all their degrees, all their resources, you have no chance as a retail investor because you're dumb, right? That's what I tell you, bastards, okay? But what's the fact? What's the reality? The reality is that the amateur investor has numerous built-in advantages. We have many advantages that the professionals do not have. If we learn to exploit our advantages, our strengths, it should result in us outperforming the experts and also the market. And again, this did not come from me. I didn't say this. This was said by who? Peter Lynch, who was the greatest fund manager of all time, and he retired in the 90s, right? And he said, I've said before that an amateur who devotes a small amount of time and study should outperform 95% of the paid experts who manage mutual funds plus have fun doing it. Okay, so do you feel proud to be a retail investor? Yes or no? Very good. Okay. So that has been my mission. Now, those of you who have been following me for many, many years, you know that I started teaching in 2005. That was my very first investment class. And in the old days, I used to teach physically in the function room, right? But ever since COVID, ever since COVID, now I only teach online so that I can reach people from all around the world and you can learn comfortably in your bedroom. And I was very proud that I was featured on the Pulses magazine. This was a publication of the Singapore Stock Exchange back in 2006. So uh, this is about 19 years ago, okay? Because at that time, I was one of the first Singaporeans to invest in the US markets when it was very rare at the time. And I was one of the first Singaporeans to buy US ETFs. And at that time, most people had no idea what's an ETF. So I went around educating people 20 years ago about ETFs, and I still do it today. Now, people say, how much longer are you going to teach? I say, probably until I die. Okay. So my dream is to die teaching. That one day I'm doing a webinar, I say, guys, go for your dreams, and then I die. That's my dream. Die in front of my computer. Okay. But I've been teaching for 20 years. But in a way, Piranha Profits was only created in 2019. Piranha Profits, the online school, created in 2019. Sorry, not 2019, 2016. 2016. But in 2020, Piranha Profits became world famous because of my Coke video, if you guys recall that. And I was one of the few people who said that the market's going to go higher. And many people thought I was either stupid or crazy, but of course, we made a lot of money. And you can see in April 2020, I created a video. I explained, I said the bull market is back. And those retail investors who followed this advice, they made a lot of money. I've got students who made millions of dollars, millions of dollars. I've got students who are financially free because of this video. Same thing in 2023, when professionals said it's gonna be a recession, I said no, the bull market has begun. This was on 15 January 2023. Okay. So these are my students from all around the world. People like Chun Wee said, my investing journey was consistently losses over a decade, struggling to find a winning strategy until I discovered the value momentum investment course, which completely changed my mindset and philosophy. 2023, he got 84% return. 2024, he got 103% return. He probably beat 99.9% of all the professional fund managers. And he's so-called the dumb money. People like Juper, I hope you watch his video, which I just published on YouTube. Go watch it. Juper's from Texas in the US, originally from Philippines and then Saudi Arabia. Now he's in Texas. And he was a nurse. And now he quit his job as a nurse and he's a full-time investor and stay-at-home father. All right. And in the last 4 years, he got 242%. By the way, this is not updated. The latest update, he's up, I think, 270% so far for the last 4 years. And then people like Andrew, he said, here's my returns for 2024. And he said, with my portfolio performance this year, I finally completed a full circle in getting back all my losses suffered in the stock market after 12 years. It's indeed a milestone for me. Okay. How many of you here have lost money before? Because of bad investment decisions, because of listening to someone else or listening to some expert or reading the news? Who has lost money before? If you have, you are not alone. Many people have lost money before. Me too, okay? I started investing at 17 years old. For the first 7 years, I listened to the experts. I made all the stupid mistakes. I read the news, influenced by the news, went in circles for 7 years. But I didn't give up, right? I kept learning. I kept moving forward. And when I finally learned how the market works, how it's manipulated, I learned how to overcome the manipulation. That's how I made millions in the market. And you can. It's all about education. So remember this. Your past does not determine your future. Write this down. Your past does not determine your future. It doesn't matter how many mistakes you made in the past. It doesn't matter how much money you lost in the past. What matters is what you do now. Is the decision you make today, the actions you take today, the strategy you use today that's going to determine your financial destiny. And every moment is a new opportunity. This moment is a new opportunity, but you got to grab it right now. Okay. Now, some of you will say, okay, I don't want to just listen to how much money you make or how much money your students make. Tell me what I can do. Okay. What can I do differently? So let me start to educate you guys. So how do we retail investors beat the market and outperform the professionals? Here are a few rules. Are you guys ready to write this down? Ready to write this down? Okay. Rule number 1, if you want to outperform the professionals, then you must ignore economists and ignore the professional analysts' predictions. Why? Because the reality is no one can predict the market. No one can predict the economy. And if you attempt to predict the economy and the market, you will not make money. Trust me, okay? So again, this is what happened. What happened after the COVID crash again? After the COVID crash, the economists, the smartest economists in the world said that this will unleash the worst recession since the Great Depression. And because many of these fund managers, they have to listen to their economists from the bank or from the fund management company, right? They have to listen to their bank analysts. And by listening to all this, they sold here and missed the rally. Same thing. After the crash in 2022, what did most economists say? They say a global recession is inevitable in 2023. So professionals, they listen to economists, they sell here, they miss the rally again. And then a crash over here. Again, Jim Cramer warns of the Black Monday worst crash since 1987. You listen to all these experts, these analysts, you sell here, you miss the rally again. So if you want to make money, so for me, how do I make my investment decisions? I don't listen to economists. I don't listen to analysts. I don't read the stupid fake news. What do I look at instead? What do I look at instead? So for me, before I decide to buy or sell something, what do I look at instead? Make a guess. I look at two things. I look at two things. The first thing I look at is I look at the fundamentals of the underlying business. I call this, or not I call this, right? This is called fundamental analysis. So for example, during the COVID crash, one stock I bought a lot of was Microsoft. Why? Because I look at the financial statements of Microsoft and I ask myself, is Microsoft losing money? No. In fact, during COVID, Microsoft, their revenue went up, their profits went up. So the business was actually doing well in the pandemic. But the share price dropped 30%. Why? Because of manipulation, because of panic. So as long as I find that it's a great company that's making money and it is undervalued, I will buy. I will buy, regardless of the news, regardless of the economies. Screw them. Screw them. Just look at the company. You understand? That's the first thing I look at, the fundamentals. Then to time my entry, to better time my entry, I look at technical analysis. Now, is technical analysis a guarantee? Is technical analysis a guarantee? No, it's not a guarantee. It's not a guarantee, but it increases your probability. It gives you a statistical edge in the markets. So those of you who have been following my videos, you know that I use a lot of technical analysis techniques like support levels, like moving averages, and as well as the Williams percentage R indicator. So if you recall, this is what I shared many times in my YouTube videos. Okay, I use the Williams percentage R indicator. Now, I use both of them together, the 52 period and the 13 period. And this works on weekly candles on the S&P 500. So I use this to identify potential bottoms. Now, how does this work? Again, I've taught this many times in my YouTube videos. I'm just going to remind you, okay? Now, whenever the Williams 52 is below minus 80, can you see this minus 80 here? Can you guys see this minus 80 here, just to check? Is it too small? Can you see that? Okay. So whenever this Williams 52 goes below minus 80, and this Williams 13 goes below minus 80, they must both go below minus 80. That is an indication of a potential bottom. So you can see here, it went below minus 80, went below minus 80. That was a potential bottom. And sure enough, that was a bottom. Now again, is it a guarantee? No guarantee, but it identifies potential bottoms. Now, let's look at it again. Where did it happen before here? There. You see below minus 80, below minus 80, right? Below minus 80, below minus 80, below minus 80, below minus 80. So you can see that in 2022, when the market crashed, the first potential bottom was here. This was the first potential bottom, number one. So if you saw this, could you have bought here? Yes or no? Could you have bought here? Yes. Now it went up, and what happened after it went up? It made a double bottom. We call this a double bottom. And again, you see this pattern appear again. Okay. So sometimes when this indicator tells you it's a potential bottom, yes, it will go up, but it may make sometimes a double bottom. Now, does it matter? It doesn't matter, all right? So whether you bought here or you bought here, would you still make a lot of money? Yes or no? Yes. And I keep telling people when you buy, don't buy at one go. Buy in tranches. So for example, when you hit the first potential bottom here, you could buy maybe 1/3 of your position or 1/4, for example. Then when it hits a second bottom, you buy another 1/4 or buy another half, right? Then it goes up again and then it retraces down, buy again. So you slowly buy. Don't buy at once. Slowly buy. And then when it goes up, you'll do very, very well. And even if your average cost is here, you'll do very well. So remember, we can never buy all the time at the exact bottom. We can never buy at the exact bottom. But as long as we buy near the bottom, it's good enough. We'll do better than all the professionals. Make sense? Now, same thing here. Check it out. This was below minus 80, below minus 80. Again, that was the bottom here. Can you see that? That was one bottom. Here again, below minus 80, below minus 80. That was the bottom here again. Here. So no more here. So this is one of the indicators that I use all the time to look for potential bottoms. Okay. Is this useful, guys? By the way, I learned this from Larry Williams, who is someone I highly respect. He's one of the best traders in the world. He's, I think, about close to 80 years old right now. And I've been using this for many, many years, right? Now, many of you also know that I use moving averages. I use moving averages to identify trend changes, right? To identify trend changes. So same thing. As long as I find that this stock, the business is doing well, the revenue is growing, the profits are growing, it's undervalued, I'll buy. But again, I'll look at the technical analysis. Is it at the support level? Is the Williams R oversold? And is there a change in the trend? So this blue line here. Can you see the blue line? This blue line is the 50 simple moving average. The green line is the 150 simple moving average. This works on daily candles. So just remember, when the 150 is above the 50, that means it's a downtrend. I repeat, when the 150 is above the 50, that means it's a downtrend. So you can see that this is a downtrend over here. So if I can draw, right, this is a downtrend pattern. And in a downtrend, you've got wave up, wave down, wave up, wave down, wave up, wave down, wave up, right? So this is the downtrend. So how do you know when the downtrend reverses into an uptrend? Again, this is something you will learn in my courses in detail, but here's a very quick lesson. For the trend to change, the blue line, the 50 moving average, has to cross above the 150. The blue line has to cross above the green line, and the two lines must be sloping upwards. They must be sloping upwards. If one line is sloping down, it is not a change in trend. The slope has to change. So you can see over here, let me kind of like rub this away, okay? So can you see here the 50 moving average? The blue line cross above the green line. Can you see the cross over here? The blue line is sloping up, the green line is sloping up. This was a trend change. This is called a trend change. Okay? And sure enough, you can see that this is a new uptrend pattern. So on an uptrend, you've got wave up, wave down, 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 and the trend changes. So the moment I saw this trend change, I was confident that it's a new bull market, and that's why I made this video. I say the bull market has begun, right? The bull market has begun. Now, by the way, did I wait for this trend change to buy? Did I wait for this to buy? Did I wait for this to buy? No, I already bought here. I already bought here. Now, how did I buy earlier? By using the Williams percentage R. So the Williams percentage R lets me buy near the bottom. And then when I get an uptrend confirmation, I buy more. All right. And that's why once the bull market started, by the time the bull market started, I was already up almost $500,000. Even before the uptrend, I was up $500,000. Well, almost $500,000, right? Okay, so anyway, all this you will learn in the value momentum investment course. I go through all this in detail. And yes, some of you are asking about Stock Oracle. Stock Oracle is available for purchase as well. But you're going to get a very special deal where you get it. You're going to get Stock Oracle as part of my course. Okay, and I'll talk about the offer later on. And with Stock Oracle, you can actually look at all these indicators as well, right? Yeah. So that is the first lesson. Ignore economists and analysts. Okay, what's the second lesson? Lesson number 2, to beat the professionals, you should be very, very strict. And you should only invest in the top 1% of stocks in the whole market. I tell my students, I say in the market, 99% of stocks are not safe to invest in. I repeat, please write this down. Write this down, everyone. 99% of stocks are not safe to invest in. You can trade them for a one-night stand. You can do short-term trading on the 99%, no problem. But if you want to invest and close your eyes without a stop loss, you can only do it on the top 1% of stocks. These are the highest quality stocks that make consistent profits, that have got strong economic moats. I'll talk more about this later on, how I qualify the top 1%. That's coming up later on. Hold on, okay? So only invest in the top 1% of stocks when they are what? When they are significantly undervalued. When these great companies are selling at a discount. Now, let me ask you this question. When is a great company ever selling cheap? If the company is so great, if it's such a fantastic company, when does it sell at a discount? When there's bad news, right? When there's bad news, oh my God, there's a pandemic, there's tariff, there's a high interest rate. So whenever there's bad news, that's when great companies, they go on sale. And that's when I buy, right? So over here, so take advantage of market panic, of bad news to buy mispriced high quality stocks. Now, but please be very careful. Only buy the high quality stocks, the 1%. 99% of stocks are not high quality. They are not high quality. Many of these companies that are not high quality, when they drop, they never come back. They never come back. Okay. So I always say that there are two kinds of stocks. The top 1%, I call them the tennis ball stocks. You know tennis ball? Now, tennis ball stocks, when they drop, what happens? When a tennis ball drops, what happens? It always bounces back up. Okay? And sometimes the harder you throw the tennis ball down, the faster they bounce back. Okay? These are tennis ball stocks. These are good businesses. But many stocks are what I call the egg stocks. When you drop an egg, okay, they don't bounce back. In fact, you drop it hard enough, the egg will crack. Understand? So you got to be very careful. Now, the trouble with most people is they can't tell the difference between a tennis ball stock and an egg stock. They say, I don't know the difference. Okay? So later, I'm going to go through with you how I identify tennis ball stocks and how I avoid the egg stocks. Understand? Okay. Now, this sounds like common sense. But do the professional fund managers all follow this? Do they all follow this? Do they only buy the top 1% of companies when there's a panic, when it's undervalued? No, they don't. Not all of them. Some of them do, but not all of them, right? Why? First reason is you must understand some fund managers, they have got fund mandate restrictions. So fund managers may not be able to buy certain stocks because it is not within the mandate of the fund. That they can't buy a certain market or certain sector or certain industry, or the market cap is too small for the stock, they can't buy the stock. Okay. However, as retail investors, we are not restricted by any mandate. Okay. Retail investors can buy any stock as long as it meets the criteria of a great business. Whether it's a big company, small company, in China, in US, in India, we don't care. Okay? We've got no restrictions. That's our advantage. Number two, most fund managers, again, most, not all, most are short-term focused. Because if fund managers underperform over a couple of quarters, they run the risk of their investors withdrawing their funds, or they don't get their bonus, or the fund manager may get fired. So because of that, many fund managers, they focus on buying stocks that are doing well in the short term, that are going up. We call these stocks in favor. So like now, which stocks are in favor? Which stocks are going up like crazy? Which stocks? You tell me. AI, right? AI. So right now, a lot of the fund managers, they'll buy AI. But which stocks are now being hated? Which stocks are now like no one wants it? Healthcare, right? A lot of the healthcare stocks are like United Health, Elevance Health, like all dropping like flies, right? So you find a lot of the fund managers, they won't buy, many of them won't buy the healthcare stocks because it keeps going down. They don't want to be fired from the job. Okay. So they buy stocks in favor and they avoid stocks out of favor. So as a result, they tend to buy the overpriced stocks and they avoid the cheap stocks. Okay. But to beat the market in the long run, we need to be contrarian. To beat the market in the long run, we need to be contrarian. So you find that great investors buy stocks that are hated in the short term, okay, that are out of favor and they are significantly undervalued. And because of that, they may underperform the market in the short term, but in the long term, they way outperform the market. Let me give you an example, right? How many of you remember that in 2022, it was the opposite? In 2022, a lot of the technology stocks were dropping like flies. Any of you remember that? In 2022, Nvidia collapsed, Meta collapsed, Amazon collapsed, Netflix collapsed, right? Everything dropped. So at that time, a lot of the fund managers, they were selling the tech stocks. They were selling, right? What was I doing? I bought Nvidia at $15. I bought Nvidia at $15. I bought Palantir at $9. When no one wanted Nvidia, nobody wanted Meta, nobody wanted Amazon. They say it's crap. I bought it in 2022. I buy when nobody wants to buy, right? But in 2022, healthcare was doing very well. Healthcare stocks were going up. Luxury stocks like LVMH was going up. Consumer staple stocks like Pepsi was going up. Hershey's was going up in 2022, right? Now it's the opposite. Now the tech stocks are going up. People love Palantir, people love Nvidia, people love, right? But now people hate the healthcare. So it's always a rotation. It's always a rotation, okay? So you find that many fund managers, they will tend to cut exposure to stocks with high volatility to ensure acceptable quarter by quarter performance. While this reduces volatility in the short term, they do not generate significant future gains. Okay. Now it's all about balance. Am I saying that now I sell all my tech stocks? No. I'm still holding my Palantir, I'm holding my Nvidia, I'm holding my Microsoft. Because over time, they will still do very well. But am I buying more right now? Am I buying more Palantir right now? Am I buying more Nvidia right now? No. No. Because right now, they are not cheap anymore. No more cheap. All right? Once they get cheap in the future again, I'll buy again. But right now, I'm buying United Health, which people are booey. They're spitting a stupid healthcare or dying. Get out. Well, same thing happened 2022, right? So you got to think contrarian, okay? Not like the short-term people, right? So Let me give you a few examples. You guys heard of Google? Yeah. Google has been hated many, many times. And in fact, just last month it was hated. Now people are starting to slowly love Google again. I miss you. But they were hating Google. Google's gonna die. ChatGPT is gonna eat your lunch, right? Now take a look at this. This was back in 2023 and 2024. All right. And the best time to buy a great company is when there's bad news. So what was the bad news here? Google shares dropped 100 billion after new AI makes a mistake, right? It dropped, I buy. Google cloud revenue profit misestimates. Buy. Dow tumbles 400 points. S&P suffers the worst day since inflation was era. Oh, we're gonna die inflation. Buy. Google loses fight against 2.7 billion EU antitrust fight. We're gonna die. Buy. Google faces US government attempt to break it up. Oh, we're gonna die. Buy. Notice every time there's bad news, the stock will drop, the stock will drop, the stock will drop, the stock will drop, and it goes below the intrinsic value. These are the times to buy it. But again, be careful. Only do this on tennis ball stocks because tennis ball will always bounce back. They always bounce back. They always bounce back. They always bounce back because the companies are making a lot of money. But you do this on companies that don't make money, the egg stocks, they drop, they don't come back. So you got to know the difference. All right. Meta. And in the old days, it was called Facebook. Okay. And this was back in 2017, 2018, 2019, 2020, 2021. Everyone hated Facebook. They hated Mark Zuckerberg's face. In Singapore, we say he got CB face. Want to give him one tight slap. Hui! Right? Everyone hated Facebook, right? And look at all the bad news. Facebook stock tumbles again. Data scandal. We're gonna die. Facebook fine because of Cambridge Analytica scandal. We're gonna die. Facebook shares extend slide as Starbucks joins major global brands in social media boycott. Everyone boycott Facebook. We're gonna die. Tech stocks close sharply lower as bond yields jump. Whistleblower SEC complained Facebook's new platform was used to promote human trafficking. Oh my God, we're gonna die. Look at all this bad news. Now, if you bought every time there's this bad news, you would have bought Facebook as what? At $120. You bought at $160. You bought at $250. You bought at $300. What's the price today? What's the price of Facebook today? It's over $700. Okay. And I haven't sold a single share. I have not sold a single share. And I'm still holding because do I think Facebook or Meta can double and triple from here? Absolutely. Absolutely. All right. It can easily double, triple, and 5x from here easily. Okay. Not overnight. Not overnight. It'll take time. Okay. But I'm waiting for I'm waiting for more bad news. I love bad news. I love it. When there's bad news, I get so turned on. I salivate when there's bad news. Okay. Good. So that's number 3. You guys still with me? Okay, very good. Number 4. If you want to beat the Wall Street professionals, you want to beat the market, you must hold on to your winning stocks for the 5x, 10x, 20x return. One of the things that I learned about Warren Buffett is this. By the way, do you know that in 2016, Warren Buffett bought Apple? You know that, right? He bought it in 2016. And from 2016 to today, that one stock called Apple has made more money for Warren Buffett than all the stocks he has bought in the 50 years before Apple. Think about that. Huh? Think about that. Huh? The one stock Apple has made more money for Warren Buffett than all the stocks he has bought in 50 freaking years. So one of the things that I learned by studying Warren Buffett is this. It's called the 20-80 rule. Have you guys heard of the 20-80 rule? 80% of your profits will come from 20% of your stocks. But in order to get the big profits from 20% of the stocks, you cannot sell too early. You must hold the stocks long enough for them to 5x, 10x, 20x. The trouble with a lot of people is this: they buy a stock. Okay, so let me give you an example, right? So I bought Palantir at about $9. All right. Let me just show you, for example. Where's my, yeah. Oh, crap. Oh, no. Ah, I wanted to show you my account, but now they've got maintenance. Darn it. Ah, yes, it's here. Okay, but the other one is down. Oh, it's here. Okay, but it's under maintenance, but now I can still show it to you. All right. So can you see Palantir here? So my average price is $9, right? And now it's at $153. So I'm up 1,400% on my Palantir position. By the way, I already sold about half of it. I sold half my Palantir. This is the other half I'm still holding, right? Because Palantir is now quite expensive, so I decided to sell half of it. If it was not too expensive, I wouldn't have sold, right? So right now I still have 192,000 in profits, but I already took profit on about over $250,000 on that. Okay. So when I first bought Palantir at $9, okay, a lot of people bought together with me, right? And the moment it went to $20, what happened? A lot of people thought, oh, $20, the price already doubled, take profit, right? But what happened? From 20 went to 30, went to 50, went to 100, now 150. And I'm still not selling my other half. I'm going to hold it because I think there's a lot more upside in the long run. Okay. Same thing with Nvidia. I bought Nvidia at $15. This is based on the share split price. I bought it at $15 in October 2022. And a lot of people bought it as well. But when Nvidia went from $15 to $30, what did people say? Oh, it's really double in price. It's too expensive. They sold it at $30. But now it's at $170, right? It's gone up more than 10 times. And I'm still not selling my Nvidia. I'm still not selling. Why? As long as the company is still growing, as long as it's still making money, as long as it's still dominating the industry and it's not way crazy overpriced, I will hold it to get the 10, 20x return. That is how you make millions and millions of dollars. If you take profit at 20%, 30%, 50% take profit, you'll make what we call it kacang putih money. Right? How do I say that in English? You make peanut money, right? If you want to make millions of dollars, you got to resist the temptation to take profit early. You must let it run and compound to millions. It's not easy. Psychologically, it is not easy to do it. That's why in my community, I'm like a psychologist. I do my best to remind my students, don't think of the short term. Don't think of quick profits. Think of the big picture. Think of compounding into millions and millions, right? And that is the psychological shift, right? Now, again, the trouble with many fund managers is they don't think long term. They don't think long term. They think very short term. And many fund managers may be forced to sell their best stocks because of rebalancing. They've got a rebalancing mandate from the fund. Common portfolio management guideline is that no single stock can exceed 5 to 10% of the total portfolio. This means that portfolio managers need to trim their best stocks when their prices move forward. That's why most of them cannot beat the index because they are forced to sell the good stocks once it goes up. But people like Warren Buffett, people like Peter Lynch, they did not follow this rule. They did not follow the rule. That's why they did very well. So Buffett doesn't think like a institutional investor. Buffett thinks like a retail investor. Same thing. Peter Lynch, although he was a fund manager, he thought like a retail investor. He didn't think like a professional investor. That makes a difference. Okay. So far, is this useful, guys? Are you learning something new? Okay. So someone asked this question, Adam, if I don't have Amazon, Nvidia, and Microsoft yet, should I buy? The answer is yes, but not right now. Don't buy it right now. Wait. All right. Now, number five. Number five. How we can beat the market also is to turbocharge our investment portfolio by using options. Okay, by using options. So I use a lot of options. I trade options almost every day. Now, again, most fund managers, they are not allowed to use options. They are not allowed to use options. Okay. Hedge funds can use options, but most hedge funds, they don't sell options. They buy options to hedge their portfolio. And by buying options to hedge their portfolio, it reduces their volatility of the fund, but it reduces their returns. That's why most hedge funds cannot beat the market because they do a lot of hedging. Okay. But I do the opposite. Myself and people like Bang Fan Van and Alson Chu, we don't buy options. We do not buy options. We rarely buy options. What do we do instead? We sell options. And I'll talk more about it tomorrow in my options webinar. So I sell cash secured put options. I sell covered call options. I sell credit spreads. And by selling these options, I collect premium. I collect premium. In fact, I sell these options to fund managers. I sell them insurance. They buy insurance from me because they're chicken shit, right? And I earn the premiums, and that increases my returns. Make sense? Okay. So let me go into greater detail about how to beat the market and achieve 20% or even 40% annual returns with less stress. Okay. So again, how do we beat the market? How do we beat the professionals? By only picking the top 1% of great businesses in the market and buying them only at what? Significant discounts. Okay. So what's the first key? The first key is to only buy what? Is to only buy great businesses. Is to only buy great businesses. Now, why is this important? Let me show you why. Now, again, remember my analogy. When you buy the index, like the S&P 500, it's like you're buying a what? You guys remember my analogy? When you buy the index, you're buying a music what? What's the analogy? You're buying a music album, all right? In the old days, we bought music albums with 30 songs. Were all the songs great songs? No, unless it was ABBA or Queen, okay? But no. But if you knew what were the great songs, you wouldn't buy the whole album. What would you buy? If you only wanted the nice songs, you would buy the singles, right? The hit singles. So same thing in the stock market. So you can see that in the last 3 years, okay, if you bought the music album, the S&P 500, without using any brain, you would have gotten 72% return on your money in 3 years, okay, without using any brain. But if you bought the hit singles, the most profitable companies, like if you bought Booking.com, you can see you would have gotten 203% return. If you bought Mercado Libre, you got 313% return. You bought Meta, you got 340% return. You bought Broadcom, 487% return. Nvidia, 940% return. Palantir, 1,600% return. So when you only buy the hit singles, if you know what are the hit singles and you buy the hit singles only, you will beat the market by 3 to 20 times. Okay? And these are all the kind of stocks that I own. Again, of course, not all my stocks will 3 to 20x, right? Of course, not all, right? But a lot of them. So let me show you my portfolio in full transparency. Again, right now, I'm using Interactive Brokers. So they're down on maintenance. So unfortunately, some functions I can't show you. I wish I could, but let me just show you. So this is my first portfolio. Okay. And yeah, you can see I'm holding ServiceNow, Microsoft, Meta, Nvidia, Amazon, Mercado Libre, Alphabet, Broadcom, Fortinet, Booking. And this portfolio now I've grown it to 5.18 million US dollars. Okay. And this is my second portfolio, which basically has the same stocks. Uh, right. This is again Amazon, Meta, Nvidia, Palantir, Mercado Libre, Fortinet, Booking, Broadcom, ServiceNow, Celsius, right? United Health, right? I just started buying United Health again, Mastercard. So this is now 5.67 million US dollars. So if you add it together, in total, it's about 10.85 million US dollars. Okay. Now I'm from Singapore, so I think in Singapore dollars. So this is roughly about it's roughly about 13.9 million Singapore dollars. Okay. Now I have got my capital gain portfolio. So this is what I call my capital gain portfolio in order to grow my wealth. But I also have my dividend portfolio. My dividend portfolio, I only buy Singapore stocks that pay dividends, like the Singapore banks and the Singapore REITs. So my Singapore portfolio, I'm using DBS as my broker, right? So you can see I'm holding DBS, I'm holding OCBC, UOB, CapitaLand, right? And I've now grown this to $5.16 million Singapore dollars. So if you add it 5.16 to 13.9, it's just over $19 million of US and Singapore stocks that I manage every day. So the reason I want to show this to you is not to impress you, is not to show off to you, but to tell you that I have a lot of skin in this game. I've got all my skin in this game. So whatever methods I teach you on investing is not theory. Okay. These are the actual methods that I use every day to manage over $19 million of my own money in the market. So when the market goes up, goes down, goes up, goes down, I see my portfolio going through that kind of volatility as well. So I understand, what it feels like, right? Okay, so I hope I can log into my account. Let me show you my account. Let me just log in to show you my recent performance. In case sometimes it's under maintenance, I can't log in. Okay, yeah. So I just logged in. Great. So you can see that my performance for the last 1 year, the last 12 months is 22%, versus the S&P 500, which is up 14%. So I outperformed the S&P 500 in the last 1 year. And in the year to date this year, I'm up 10.6% versus the S&P up 7%. So again, my job is to beat the market consistently, which I do with my students, right? In terms of dollar gains, you can see year to date up 900,000 US, and the last 12 months up 1.5 million US. Now, again, this is only short term. I always say that in the short term, any idiot can beat the market. Any idiot can beat the market in the short term because I could just be lucky, right? So let me show you my past year's returns. So last year, my first portfolio, which I showed you, was up 24% last year. This was 2024, January to December. And my second portfolio was up 22.4% last year. So this was 900,000 US gain, 800,000 US gain. My total gain was 1.7 million US last year, 2024. 2023, my first portfolio was up 48%, and my second portfolio was up 43%. My total gains was 2 million US dollars. So again, can I get 40% every year? Can I get 40% every year? No. Okay. So I wish I can tell you, oh, every year I can get 40%. I can't. Okay. It's not realistic. So some years I get 40%, some years I get 22%, some years I get 30%, some years I get it averages out, right? So my average is about 20%. That's my average. Now, over the longer term, this is my performance for the last 6.5 years since I started the UIP. So UIP is the ultimate investors playbook where my subscribers, they can track my portfolio and they can see every stock that I buy, I sell every single day. and it's like basically watching over my shoulder, and they watch how I invest and trade every day, right? So there's a model portfolio, and you can see that in the last 6.5 years, despite two major crash, 2020 crash, 2022 crash with a major pandemic recession, with a Silicon Valley Bank collapse, with the Ukraine war, with the Middle East war, and despite all these problems, my portfolio in blue returned 237%. Okay, versus the S&P 500, the music album that returned 158%. Okay, so that's why I tell all my students, never be afraid of market crash. Never be afraid of recessions. Never be afraid of war. Because if you hold good companies, if you hold tennis ball stocks, then no matter how many times the market crashes, you don't worry because your portfolio will still double and triple over time, despite the short term up and down. Does this make sense, guys? Right? And this is a longer term portfolio, a performance, sorry. The last 10 years, you can see my portfolio up 541%. Since inception, up 700%. Okay, so I beat the market in the short term, I beat the market in the medium term, I beat the market in the long term. Okay, now, like I said, you don't have to learn from me. You can learn from someone else. It doesn't really matter to me. Okay, but whoever you learn from, please ask them to show you their performance in the short term and in the long term. Ask them to show you their actual account because I think that no one else out there would ever show you this stuff. Okay. Okay, so how many of you would like to learn specifically how to invest more successfully? All right, so write this down, guys. Write this down. This is the important stuff. Okay, by the way, I know a lot of you have questions, and again, I'll do my best to answer them at the Q&A session at the end of the webinar. So please stick all the way to the end. Yeah, because if I answer your questions now, then I don't have time to finish my curriculum, right? So please understand that. Okay. So there are altogether 4 keys. There are 4 keys to successful investing. I like to use the acronym WWHW. So write this down. WWHW. So what's the first key? Let me just write down numbers. 1, 2, 3, and 4. Okay. So what's the first key to successful investing? The first key is you must know exactly what to buy. You must know exactly what stocks to buy. Again, there are over 10,000 stocks in the US market. There are over 600 in the Singapore market. There are another over 15,000 in the China market or in the India market, right? Thousands, right? And do we want to buy all the stocks? No, we only want to buy the best stocks. Now, what is a stock? When you buy a stock, what are you buying? You are buying a business. Always remember, when you buy a share of stock, you are buying part of a business. You're becoming the shareholder of a business. So, in other words, we only want to buy what? We only want to buy great businesses. Please write this down, everyone. We only want to buy great businesses. We're not interested to buy mediocre businesses. We're not interested to buy lousy businesses. We only want to buy great businesses. Again, you may ask, how do I know it's a great business? So later I'm going to show you, I've got a 7-step criteria to select great businesses. That before I buy, it must pass my criteria. All right, so that's coming up in a while. Hold on, okay? Now, criteria number 2, once I know exactly what to buy, what's number 2? Is you must know exactly when to buy it. When to buy. Remember this, a great business can be a lousy investment if you buy it at the wrong time. If you buy the great business at an overpriced level, it can become a bad investment. But If you buy a great business at less than what it is worth, if you buy a great business when it's undervalued, it can become a great investment. Okay. So in other words, we only want to buy great businesses when they are undervalued. How do I know it's undervalued? So later I'm going to show you how I calculate the intrinsic value and how now with Stock Oracle, it will automatically calculate the intrinsic value for you in seconds. So it makes your life very simple. All right. Let me give you an analogy. Let's imagine you want to buy an apartment and you find a great apartment, great view, great location, beautiful renovation. So what do? You want to get a valuation. So you say, hey, what's the bank valuation? And the bank says, well, um, this apartment is valued at $1.5 million. Okay. But let's say, for example, the seller asked for 2 million. And because you were so excited, you loved the apartment so much and you were afraid of losing out, you say, okay, I'll pay you 2 million. So if you pay $2 million for the apartment, is that a good investment? Is that a good investment? No, because you pay $500,000 above valuation, right? So it may take you longer to eventually break even on your investment, true? But let's imagine you found a seller who was desperate to sell because maybe he's going through a divorce or his business was going bankrupt and he had no choice. He says, nobody else wants to buy my apartment, so I'll give it to you for $1 million. So he buy it for 1 million. Now, is that a great deal? Yes, because you buy $500,000 below valuation, right? That's a great deal. That's a great investment. Now, can you find these deals easily in the property market? Can you find these deals easily? No, it's very difficult to find a desperate seller who's going through a divorce, who's going through bank. It's very hard, right? But you know something? In the stock market, it's very easy. That's why I love the stock market. Because stock markets, you can find great businesses selling at 20, 50% discounts. Because in the stock market, there's a lot of manipulation and there's a lot of panic selling, especially now thanks to a mad King Trump who says crazy shit. People say, we're gonna die, sell. And I'm waiting, right? I'm waiting to grab these apartments at 30, 50% discount. So that is how I make millions. That is how I make millions by taking advantage of the short-term panic and buying great companies at 30, 50% discount. So in my course, I show you exactly how to do this. How to look for these great businesses, number one. Number two, when to pull the trigger, when to get in and start accumulating. Is that cool? Okay. Now, that's the second key. The third key is you must know how many shares to buy. Okay, you must know how many shares to buy. Write this down. Why? Listen very carefully. Because no matter how great you think a stock is, no matter how great you think this business is, never put all your money in one stock. Never. Always spread out your money into minimum 8 to 10 great companies. Please write this down. Always spread out your money into minimum 8 to 10 great companies. I don't care if you're investing $1,000 or 5,000 or 10,000 or 100,000 or 10 million. I don't care. Always divide your money into at least 8 to 10 great businesses. Why? Why? Because no matter how great you think a stock is, shit can happen that you can't always foresee. All right. So I give you an example. You guys heard of Alibaba? I'm sure you have. Okay. So Alibaba was a great business. It was like a monopoly in e-commerce. And I bought Alibaba about 7 years ago. I own Alibaba. But what happened? Jack Ma, who was the CEO of Alibaba, he went to piss off the President Xi. And President Xi gave him one tight slap on the face and exiled him. And they cracked down on all the Chinese tech companies and imposed a lot of regulations and restrictions. And for the first time, Alibaba, their profit dropped significantly and the share price dropped 50, 60%. And I own Alibaba, right? So in 2021, my Alibaba dropped 50%. But did I care? Did I care? I don't care. Why? Because although my Alibaba dropped 50%, my other stocks did very well. So at the end, in 2021, I still made over 30% return. Same thing with Boeing. You guys heard of Boeing? I used to own Boeing. In COVID, because of the pandemic and the plane crash, Boeing share price dropped 70%. I own Boeing. My bloody Boeing stock dropped 70%. But I didn't care because in 2020, I still made 40% return because I had other companies that made up for it. You get the point? So that's why it's very important to diversify into several different industries, into several great companies, so that if one or two stocks shit happens, okay, and it drops temporarily, it doesn't matter. The rest will hold up your portfolio and give those stocks a chance to rebound eventually. So, by the way, I'm still holding Alibaba. I've not sold Alibaba. I've been holding it for 7 years. I'm still holding it, right? Because although it's not great business anymore, but it's still making money. It's still not too bad, right? So I'm still holding it, and now it's beginning to come back, right? So I think Alibaba should soon be able to get back to 200 and $300. So I'm still holding it, right? But Boeing, I sold. I sold Boeing for a slight profit because I feel Boeing has got too many problems. But at least I sold it eventually for a nice profit. So in my investment course, I spent a lot of time talking about portfolio diversification and portfolio management. Is this useful, guys? By the way, how many of you in the past you put all your money in one stock and you got whacked? Yeah, don't do that. Don't do that. Okay. Now, let me ask you this. Would you sit on a plane with one engine? Would you sit on a plane with one engine? No. Even if it was a great Rolls-Royce engine, it won't. Because what if there's a bird strike? What if there's a engine malfunction? Then you die, right? But what if your plane had 10 Rolls-Royce engines? What if your plane had 10 Rolls-Royce engines? What's the chance that all 10 engines will fail? Very rare, right? At the very most, one or two engines fail. You at least have 8 engines to keep your plane flying. You get the point? So always make sure you've got at least 8 to 10 Rolls-Royce engines so your plane will never crash, right? Okay, the last key is you must know when to what? When to sell. Again, one common mistake people make is that they sell too early. Once they buy a stock, it goes up 20%, take profit. Goes up 50%, take profit. Goes up 100%, take profit. If you do that, you will earn peanuts. Okay? If you want your investment to go up 10, 20 fold, you must resist the temptation to take profit too early. As long as the business is still making money, is still growing, the industry is still growing, I hold on to the company. But of course, the moment it gets too overvalued, crazy overvalued, like Palantir is a bit crazy right now, I would sell half, right? I sell half, I keep the other half. So I already make back my capital plus a lot of profit. So even if Palantir goes to zero now, Palantir goes to zero, I don't care because I already took half, right? But like Nvidia is a bit overvalued, but not crazy overvalued. So Nvidia, I've not sold anything. I'm still holding everything, right? Same thing with Microsoft, same thing with Amazon. They are not that crazy overpriced. They are slightly overpriced, but I wouldn't sell a single share right now. Okay. Now, you also don't want to sell too late. So once you realize that a business is no longer great, the business may be getting disrupted, then you can decide to sell, right? So for example, Adobe, I've held Adobe for many, many years, and now I feel that there's a chance they could be disrupted. I sold all my Adobe shares, right? I made a nice profit, but I got out and I reinvested into what did I buy instead? I sold Adobe. I think I bought more Google. I bought more Google and bought more Nvidia, right? So I'll share with you what are some of my selling rules as well. Okay, and there are many things I sold as well in the past. Okay. Okay. So far, is this useful, guys? Any of you learning something new today? how many of you are beginning to realize some of the mistakes you've made in the past? Like, oh yeah, I bought companies that were not making money and I overpaid for it, or I sold too fast and I put everything into one stock and I died. Any of you start to realize that? Right. So, today I like to share with you as much as I can, but I've got less than 3 hours. It's like a movie, right? 3 hours. So I'm doing my best to dump as much knowledge as I can, but there's a limit. Okay. That's why I created my whale investor course that has got 12 hours, not 12 hours, sorry, 12 lessons and many hours of teaching so I can cover everything. So in the whale investor course, you learn everything you need to learn about how to invest. And once you learn everything, you will have the confidence to manage your own money. And you have no more fear of recession, no more fear of market crash, no more fear of what Trump says anymore. Tweet all you want, tweet, who cares, right? Because that no matter what happens, if you have got all these tennis balls, right, you will just keep doubling your money, doubling over time. All right. And that is the confidence that you're going to have. That is no more stress, no more fear. That's the best way to invest with no more worries and no more stress. Okay. So what I'm teaching you today is very powerful, but it's less than 3%. Today, I can only cover 3% of the knowledge that you need. Okay. So that's why I've got my UIP, I've got my courses so that you learn everything. Okay. So let me teach you some more. Yeah, okay. Some of you are asking, can you see what I'm buying and selling every day? Even my options trades? Yes. So when you subscribe to UIP, the Ultimate Investors Playbook, you see all my option trades, right? So everything I buy and sell every day, my stocks, my trades, I do a screenshot and I send to you immediately. Usually, within 2-3 minutes, you get to see every trade, every investment I make every single day. That is based on the UIP. So later, I'll share with you, we've got a very special offer where you get everything. You get the UIP, you will get my investor course, you get the stock oracle, all for a super crazy price. You see, you won't believe. It's like, so cheap. Yeah. Okay, anyway, that's coming up. So let me go into greater detail. Okay. So as I mentioned before, how do I identify great businesses? Okay. So I've got a 7-step criteria, to analyze great businesses. And less than 1% of stocks in the world will pass my criteria. Less than 1%. Again, these are called the tennis ball stocks. Okay. So let's run through the criteria very quickly. What's criteria number one? Criteria number one, I only invest in businesses that have a history of consistently increasing sales revenue, net income, and cash flow from operations and free cash flow for at least 5 years. Write this down, at least 5 years. So I want to make sure that the last 5 years at least, the business is able to grow their sales revenue year after year after year after year. Their profits are able to grow consistently and they're able to generate higher and higher free cash flow consistently. Why? Why? Because if a business can increase their revenue, profits, and cash flow for at least 5 years, that means the business is consistent. Please write this down. The business is consistent. Number two, the business is predictable. And number three, the business is resilient. So ideally, I want to make sure that in past recessions, in past pandemic, they can still grow their revenue, they can still grow their profits. That is a good business. Now, let me ask you this. Do you think all businesses can do this? Do you think all businesses can pass my first criteria? No. In fact, less than 5% of businesses can pass my first criteria. So if you just apply my first criteria, it would eliminate 95% of all the stocks. Okay? So let me give you an example. A lot of people, last few years, they say, Adam, Intel, you guys heard of Intel? Intel, the share price dropped a lot and it looks very cheap. Did you buy Intel? No, I never bought Intel. Why? Because Intel doesn't pass the first criteria. So let me show you. Let me go to Stock Oracle. And again, I'm very proud of Stock Oracle. Why? Because in the past, only the Wall Street professionals, okay, only the Wall Street professionals who could spend thousands of dollars a month, they had access to this financial data, this financial software. But now, with just less than $300 a year, okay, retail investors have the same financial analytic tools that levels the playing field. Okay. So, for example, let me go into Intel. Okay, great. So the first thing is, let me show you the financial statements. Okay. And look at this. This is the sales revenue in blue. Is the revenue increasing consistently? Yes or no? Is it increasing consistently? Yes or no? No. You can see that the revenue is dropping. They are getting less sales every year. Okay. Then next, look at the net income. Right? So they make money, make less money, make less money, break even, lose money, lose money. Is it consistent? Is it predictable? Is it resilient? No, right? And then here on the right, you can see the cash flow, right? The operating cash flow, the cash flow going down, going down, going down, going down, going down, right? So they generate less and less cash. And the free cash flow, negative, 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 negative free cash flow. Now, what is free cash flow, by the way? What is free cash flow? Free cash flow is the cash flow from operations that they generate minus the capital expenditure. So after minus the investment into capital, building more foundries and more factories, they are actually having negative free cash flow. So when you look at a business, free cash flow is very important. The free cash flow should be increasing consistently. Understand? Okay. Now, here's the thing. What is a business, guys? What is a business? What is a business? A business is a money-making machine. Okay? Listen carefully. A business is a money-making machine. So, the more money the machine makes, the more it is worth. Correct? So, if a business cannot make more money, right? They cannot generate more cash. The business is worth less, is worth less, is worth less. And if the business is worth less, the share price cannot go up. The share price cannot go up. You understand? So if you look at the chart, let me show you the chart here on Stock Oracle. Okay. So for example, you can see in the last 5 years, what happened to the share price of Intel? Right? Right? It keeps going down. Why? Why can't it go up? Because it's not making more money. If it doesn't make more money, it can't be worth more. You see what I'm saying? Right? So I don't invest in companies like Intel. And again, you can see the company has got no moat. I'll talk about this later. What does this mean called no moat, right? So even though it is undervalued, right? You can see the intrinsic value is $24.96. That's the intrinsic value. And right now at $23, it is undervalued, right? It is cheap. Yes, it's cheap, but cheap crap is still crap. Cheap crap is still crap. So I don't care how cheap a company is. If the company cannot make money, what's the point of owning it, right? It can't go up. Cheap become cheaper, low become lower, right? Okay, so anyway, so what business do I buy? So I buy businesses like MasterCard, for example, which I've owned for many years. Why? Let me show you MasterCard. Okay. So again, if I go to financials over here, you can look at the line chart. You can also look at bar chart, depending on which one you prefer. Okay. So let's look at a bar chart. Again, is the revenue growing consistently? Yes or no? Yes. You can see even in the pandemic, they are still growing their revenue. Even in the market crash, they are still growing their revenue. Rain or shine, their revenue is still growing. This is predictable. This is consistent. Look at the net income. The net income is increasing consistently. Look at that. Look at the free cash flow. You see the free cash flow is increasing consistently. Every year they generate more cash, more cash, more cash, right? Can you see that? So again, a business is a money-making machine. The more money it makes, the more it is worth. So MasterCard makes more money, more money, more money. The business intrinsic value keeps going up. The share price keeps going up. Okay. So let me show you MasterCard. So you can see this is MasterCard. Okay. Over the long term. Okay. So when you buy a great business, long term, the share price always goes up. Now, does it go up in a straight line? Does the share price go up in a straight line? Does it go up every day, every week, every month, every year? No, it doesn't go up in a straight line. How does it go up? It moves in wave patterns, right? Can you see wave pattern? Wave up, wave down, 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 wave up, right? It moves in wave patterns. So it's like breathing. Breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. Now, no matter how strong you are, can you breathe out forever? Can you breathe out forever? Can you go, no, right? You will run out of air. So eventually you got to breathe in before you can breathe out again. So same thing with a stock. A stock can't go up every day, every week, every month. It has to drop once in a while to shake out the weak hands in order to go higher. Okay. So if you're buying a great business, if you are buying a great business that you know will keep going up, then when's the best time to buy? Do you want to buy after a wave up or after a wave down? After wave up or after wave down? Do you want to buy at A or you want to buy at B? You tell me. B, right? Yeah. So as an investor, I always like to wait for wave down and buy before the wave up. Okay. I don't like to buy after a wave up because after a wave up, I buy, there's a high chance after I buy, it's going to go lower. Okay. Now, again, can I predict exactly where's the bottom here? Can I always predict the exact bottom? Impossible, right? You can never predict the exact bottom. So we can't always buy right at the bottom. We just need to buy near the bottom. We just need to buy near the bottom. And as long as we buy near the bottom, we will do very well. Okay. Okay, so let's move on. So that is criteria number one. By the way, later I'll show you more stocks. Okay, I'll show you a lot more companies. So in a while, yeah. Okay, criteria number two. Criteria number two is to me the most important criteria of all. Is the most important. What's criteria number two? I only buy businesses that have got a what? That have got a sustainable competitive advantage that protects it from competition. So competitors cannot easily come and take away their customers. Competitors cannot easily come and take away their market share. What does Warren Buffett call this? He calls this an economic moat. You know what's a moat? In the old days, kings lived in castles. And how did they protect the castle from the invader? They built a moat around the castle. A moat is like this water barrier. So the enemy cannot attack the castle, right? They put this moat with crocodiles and piranha and everything, right? So same thing, when you invest in a business, you must make sure it's got a wide moat that protects it from competition. Okay. So in other words, write this down, write this down, write this down. I only buy businesses that have little or no competition. Okay, you write this down? I only like to buy businesses with little or no competition. We call these businesses with a what? With a wide moat. Wide moat. Now, narrow moat, I will still buy. I will still buy it. But if a company has got no moat, then I will not buy. No moat means that there's no protection. Okay, competitors can easily take away the customers, easily take away the market share, and they compete on price alone. So we avoid those companies. Okay. Now, what gives a company a moat? What gives a company a moat? A few things. Number one is a very strong one. A very strong one. Brand that people love, people are loyal to, and people are willing to pay more for the brand. Okay. So even if the competitors cut their price, people will still buy the more expensive brand. So can you name me some companies where people are willing to pay more even though it's more expensive than the competition? Apple, Microsoft, right? Palo Alto, okay? Hermes, okay? Louis Vuitton, Ferrari, right? So these are what we call this is what we call pricing power. Please write this down. We only want to buy companies with pricing power. Okay, pricing power. That means they can raise price every year and people will still pay. Okay, people will still pay. Okay, and I like to also buy brand monopolies. A brand monopoly means that it's a top of mind recall. When you mention the product or service, it is the first thing people think about. Okay, so let me give you an example. Let's play a game. I'm going to mention a product or service, and you tell me the first brand that you think about. Okay. So if I mention the word office software, whether you work from home, you work in the office, you got to use software, right? So when you think of software, what do you think about? Microsoft. Okay. So Microsoft is has a brand monopoly. Look at the share price. Microsoft has no close competition. It's a freaking monopoly. That's why I own Microsoft, right? And you can see when it's a brand monopoly, long term, what happens? Long term, it always goes up. It always goes up. So the easiest way to make money is to buy brand monopolies, right? If I mention social media, what do you think about? Right? You think about WhatsApp, all right? You think about Facebook, Instagram. They're all owned by Meta, right? So Meta again, oh, it's a brand monopoly, right? It's a brand monopoly. You can see long term, it always goes up. Okay. If I'm not wrong, about 80% of the world's internet users uses one of their products. 80% of the world's population, okay, is a brand monopoly. If I mention videos, you want to watch movies online, Netflix. Netflix is a brand monopoly. Look at that. Netflix is a brand monopoly, right? You understand? Okay, one last example. So whether you're in Singapore, you're in the UK, you're in Australia, you're in Europe, all right? Early in the morning, late at night, you're hungry, but many restaurants are closed. But you know that around the corner, there's a fast food restaurant that you can depend on. What's that called? McDonald's. That's right. When you go to Australia, they call it Mackey's. When I first went to Australia, so have you been to Mackey's? I said, what the heck is Mackey's? McDonald's. You idiot. Yeah, so you can see McDonald's is a brand monopoly. Again, long run, it always goes up. Okay, so I love to buy brand monopolies. Okay, so they have got a wide what economic moat, right? Now, besides brand monopoly, um, or Mecca, sorry, Mecca's, my bad, not Mackey's, Mecca's, right? Okay, my bad. That's why I'm not Australian. Okay, Now, the other thing is this. The other thing that gives a company a protection is what we call high customer switching cost. High customer switching cost. This is very important. Listen very carefully. What does this mean? It means that once a customer uses the product or the service, it becomes very inconvenient or very expensive to switch to another brand. So they're kind of like locked into that brand for at least the next 5 years. Okay. So can you name me companies where they lock in the customer? Once the customer uses it, it's very hard to get out of it. Okay. Apple is a good example, right? Now, I'm an Apple user. So my entire family, we all have our iPhones. I got my Apple Watch. I got my MacBook. I got my iPad. And everything is synced to the iCloud. In my home cameras, everything is synced to the iCloud. Okay. Now, do you think I'll ever buy a Samsung phone? Do you think I'll ever buy a Samsung phone? No. No matter how cheap it is, how great it is, how beautiful, I'll never buy a Samsung phone. Why? Because if I buy the Samsung phone, it can't sync to my Apple Watch. It can't sync to the iCloud. It can't sync to my MacBook. So it makes my life very inconvenient. Right? So once you're in the Apple ecosystem, you have to keep buying Apple products. If not, you can't sync, right? And think about it. All my years of work, all my videos, all my documents are in the iCloud. All my family photos, all my family albums, videos are in iCloud. Do you think there'll be a day where I will switch out and download everything? No, it's too inconvenient. So Apple locks in the customers this way. So every time I buy an Apple product, I will curse and swear. How, I say it's so bloody expensive. They charge me $50 for bloody adapter, those bastards, those bloodsuckers. But no matter how much I curse and swear, I still buy it. Because I got no choice. I'm stuck. I'm stuck in the Apple ecosystem. It's like Hotel California. I can check out, I can never leave. But I love it. That's why I buy Apple, because it locks in the customers. You understand? What other companies lock in their customers? Software companies. Software companies. Once a big multinational company uses ServiceNow, or they use Salesforce, or they use Oracle, right? And they integrate it into the workflow, it's very costly and expensive to switch to another provider. So they lock in the customers. That's why I love software companies. Another example are cybersecurity companies. How many of you agree that all companies will need cybersecurity in the future to protect against hacking and all that, right? Yeah. So what are the biggest cybersecurity companies? Palo Alto, Fortinet, CrowdStrike, right? And once a company uses these cybersecurity vendors, it's very hard to switch because they can't afford any downtime. They can't afford any attacks in between switching. You get a point? Okay. Another example is Amazon. One of Amazon's biggest business is called AWS, Amazon Web Services. Do you know that many companies today, their entire business is built on Amazon Web Services? Like the entire Netflix business is built on AWS. And in Netflix, their financial statement, they said one of the risks is that if we ever have to migrate from Amazon, it'll take 3 years for the migration. Do you think that Netflix can afford to be down for 3 years? No, they can't even afford to be down for a few hours, right? So in a way, Amazon has got Netflix by the bees, right? they lock in all these companies. So even if Amazon raise their price, they have to pay. So I like these kind of companies, understand? Next is what we call the network effect. What does that mean? The network effect means that the more people that use this product, the more people want to use it because everyone is using it. It's like in Asia, you have to use WhatsApp. You got no choice because everyone uses WhatsApp. If you don't use WhatsApp, you can't collaborate, you can't work with people, right? So WhatsApp has a network effect. In Asia, you got to use Facebook, you got to use Instagram because everyone is doing business on these things. You got to use Google. You got no choice. You got to be on YouTube, all right? If you're selling something, you got to be on Amazon. In China, you got to be on WeChat. You got to be on Alibaba. You got to be on JD or Pinduoduo. These are called network effects. Okay, high barriers to entry because of some intellectual property uh, um, knowledge that they have. Have you heard of ASML, by the way? ASML. So to make all the advanced semiconductor chips for AI, only one company can provide the photolithography equipment to make the chips. It's called ASML. They've got a 90% market share worldwide. To make an advanced semiconductor, you have to use ASML. It is a monopoly. And China is attempting to replicate it, but they are 15 years behind. China is 15 years behind ASML. That's called a barrier to entry, right? Huge economies of scale. Where a company is so big, it can run its business at a lower cost than all the competitors. It can wipe out the competitors like Amazon, like Walmart, like Costco. Okay, so listen very carefully. Before I buy a business, I want to make sure that it meets at least three of these criteria. Okay, then it's considered either a wide moat or narrow moat. Is that clear, guys? Is that useful? Now, the best thing is with Stock Oracle, it will do all this for you. Okay, so let me just show you very quickly. Someone asked, can I buy ASML? Okay, so let's look at ASML. ASML. So straight away, if you use Stock Oracle, you can see ASML has got a what? Has got a what? Has got a what? Has got a what? Has got a white moat, right? It's got a white moat. And if you want to find out more about the white moat, right, you can just click on Oracle IQ and click on moat analysis. And ta-da! You can see that it's got a 9 out of a 10 score. And it will analyze every part of the moat. So brand loyalty and pricing power, 8 out of 10. Barriers to entry, 10 out of 10. Switching costs, 9 out of 10. Network effect, 2 out of 10. Economies of scale, 8 out of 10. So total is 9 out of 10. So this is a super wide moat company. So generally, I only like to buy companies when the moat score is at least 6 out of 10. Minimum 6. Minimum 6. But of course, if it's 7, 8, or 9, it's even better, right? Okay. But if you look at Intel, for example, let me show you Intel. You can see Intel has got no moat. The score is 5 out of 10. It's got no moat. So Intel doesn't have any competitive advantage. The competitors can do better than Intel, right? So you can see the scoring here is no moat, right? Is this useful, guys? With Stock Oracle, like I said, you now have the same resources as the Wall Street professionals. It's a level playing field. That is powerful stuff. So that's criteria number 2. Okay. Now, criteria number 3 is I only buy businesses that have high growth potential. High growth potential. Let me give you an example, right? Would you invest in a childcare business in Singapore or in China or in Japan? No, because what's happening in all these countries? The birth rate is declining. There are less and less babies being born. So no matter how well you run your childcare business, it is hard to grow, right? Because the whole industry is declining. And the only way you can grow is to fight with other competitors, and in the end, all of you will die. Okay. But will I invest in old age homes? Will I invest in healthcare facilities in the US, in China, in Singapore? Yes or no? Yes. Because the number of elderly people is growing exponentially, right? There are more and more old people, they are living longer and all that. So healthcare is a growth industry. So right now, a lot of healthcare stocks are very cheap. It's a short-term thing. In the long run, it's going to do very well. So you always look at the future, not at the present. Okay. So I invest a lot in healthcare companies because it's a huge growth industry. I invest a lot in AI related companies. Okay, because AI is the new revolution. I invest a lot in cyber security companies. All right. So I invest in high growth industries. Okay. Next thing I look at is this. I like to buy companies with little or no debt. Little or no debt and a lot of cash. Now, if you look at businesses that got into trouble, that went bust, like Silicon Valley Bank or Lehman Brothers, and in Singapore you had uh, a Nobel Group, you had High Flux, right? Guess what they all had in common? All these companies that went bust, what do they have in common? They all had two things in common. Number one, they had negative free cash flow. Number two, they had very high debt. You see, the problem is this: when a company has a lot of debt, and if interest rates rise too much or there's a financial crisis, what happens to them? They will die. Okay, they can't refinance the debt, or they have to pay too much interest on the debt, wipes out their profits. Okay, but if you buy companies with little or no debt, then you have got no worries. In the worst recession, in the worst financial crisis, even if the US government goes bankrupt, who cares? I don't care. If the US government goes bankrupt, I don't care. Why? Because many of the companies that I own have got little or no debt. So even if interest rates go up like crazy because of the US government go bankrupt, the companies I own will still do very well. All right. So you want to own companies that don't depend on low interest rates in order to do well. Does it make sense? Okay. Now, of course, there are many other things I look at. I look at high return on equity, return on capital. So once a company passes all these criteria, then I'll buy it. Got it? Okay. So let me share with you a little bit more, and then we'll look at some more specific stocks. Are you still with me, guys? Are you still alive? Can I cover a little bit more? Great. Okay. So remember, we only invest in what? The top 1% of businesses in the world. These companies, they make more and more money every year. So they keep increasing in what? They keep increasing in value. The intrinsic value keeps increasing over time. Okay. Now, but will the share price go up every day, every week, every month, together with the intrinsic value? Together with the intrinsic value? No. So remember that in the short term, the market price that you see, the stock price, does not always reflect the actual value of the business. In the short term, the stock price is driven by emotions, driven by news, and by manipulation. Okay? So when there's good news or there's manipulation or Trump tweets something, all right, a stock can go, wow! The stock price can go way above the actual value of the business, right? But then when there's bad news, oh my God, there's a pandemic, there's high interest rates, there's a war, people panic, there's manipulation, the share price can go below the intrinsic value. And then the cycle repeats, right? Where you got good news, bad news, good news, bad news, good news, bad news, good news, right? And this pattern repeats, right? That's why we've got the wave up, wave down, wave up, wave down. Okay? So we call this volatility. So as an investor of great businesses, do we like volatility? Do I like volatility? Yes, I love volatility. Why? Because volatility creates what? It creates the temporary mispricing of the business. I repeat, volatility creates the temporary mispricing of the business, where a business that is worth, let's say, $400 could temporarily be selling for 200, half price. So when that happens, we say it is what? Undervalued. But a stock that's worth 400 could temporarily be selling at 600 because of hype, because of optimism, right? And we say it is overvalued. So as an investor of great companies, when is the safest time to buy? You want to buy in this region, let's call this A, or you want to buy in this region, let's call it B. A or B. Okay, so most of you are typing B, 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 right? Correct. You want to buy at B, undervalued. So that's what you say. But is that what you do? I hope, okay? Because I can tell you that most retail investors who are not trained in investing, they always buy at A. They always buy at A. And not only that, but they tend to buy near the top. Why? Because many retail investors who are not trained in investing, they buy and sell based on what? They buy and sell based on reading the news. And they buy and sell based on emotions. So when they see the stock price going up, 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 they say, wow, everyone making money. I want to make money. Everyone gets excited about the stock. They get excited. And by the time they buy, what happened? The price already went up. And they're buying it at a premium. They're paying it. They're buying it when it's overpriced. And after they buy it, what happens? It may go up a bit more, but shortly later, it will drop. Okay? Then when it drops, what happens? Everyone panics. Ah! Then when they see everyone panic, they also panic. All right? And they sell that. Right? So they end up buy high, sell low, buy high, sell low, buy high, sell low. How many of you have done this before? How many of you in the past, every time you got excited and you bought a stock, shortly after it drops? Then after you panic, and you sell, it goes up again. What's that? How have you experienced that before? So if you experience this before, it's not because you are unlucky. It's got nothing to do with luck. It's not because of your 八字, okay? It's because, like most people, you're buying and selling based on emotions and buying and selling based on news. So if you want to beat the market consistently and you want to make consistent profits, like me, like my students who are trained, right? Then you must train yourself to go opposite of everyone else. So in other words, you want to buy great companies only when they're undervalued. But again, like I said earlier on, when is a great company undervalued? When? When? When there's good news or when there's bad news? When there's bad news. When there's excitement or when there's fear. When there's fear, that's right. So Warren Buffett has said for years, be greedy when everyone is fearful. When everyone is scared, everyone hates the stock, that's when you buy it. But of course, it must be a great business. It must be a tennis ball stock. You buy a lousy company that don't make money, it drop, never come back. Right? So that's the key to it. Understand? So let's look at a few examples right now. So right now in the market, are there still great companies that are cheap? Are there still great companies that are cheap? There are. There are still great companies that are cheap, right? So let's run through some examples now. And for example, out of the Magnificent Seven, Google is the cheapest currently, right? So again, if you look at Google, is it a great business, by the way? Is Google a great business? Is Alphabet a great business? Yes. How do you know? Well, let's use Stock Oracle. So if I go to Stock Oracle and I put Google, straight away, this will give you an overview. In terms of predictability, rank high. Profitability, rank high. Growth ranked medium, not bad. The moat, very strong moat. Financial strength, very strong. Valuation, high, means cheap. Right? Now, if you want to, now this gives you an overview, of course, but if you want to look at the specifics, let's go to financials over here. And again, you can see the revenue, sales revenue going up. You can see the net profit going up. You can see the free cash flow generating more cash. Okay. And you can see that the cash in green is a lot more than the debt. They've got more cash than debt. So they actually have got no net debt. Right? They can pay off all the debt and have net cash if they wanted to. Okay. And with Stock Oracle, by the way, you can click on this and you will do the 7 steps for you. Right? Step 1, pass, 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 pass. All the step pass. It does all the 7 steps for you. Okay. And you even tell you the mode score. Score 9 out of 10. Pricing power 7 out of 10. Barriers to entry 10 out of 10. Switching cost 6 out of 10. Network effect 10 out of 10. Okay. So this company is a super high quality company. Can you see that? So this is a great business. Okay. And you can see that over time, the intrinsic value keeps increasing. Can you see the intrinsic value? But the share price is driven by emotions and manipulation. Again, you can see good news, bad news, 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 we're gonna die, we're gonna die, we're gonna die, good news, bad news, good news, bad news, good news. So our job is to know what is the what? Is to know the intrinsic what? Value, right? So as long as the share price is below the green line, below the intrinsic value, then this is a buy area, 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 this is a buy area. Okay. Now again, must we buy right at the bottom here? Must we buy right at the bottom here to make money? No, all right? As long as it's below the intrinsic value, I will start buying, okay? So let's say, for example, the price drop here and then you buy here. Is there anything wrong with buying here? Is there anything wrong buying here? Nothing wrong, right? But after you buy, it drops even lower to here. Should you be upset? After I put it so low. Should you be upset? No, because you can't always predict the bottom because it's all manipulated, right? So even if it drops lower, who cares? Because eventually it's going to go what? Above the intrinsic value. And even when it drops here, it is still higher than where you bought it. And it goes up, it drops here, it's still higher than where you bought it, right? So how do you calculate the intrinsic value? How do you calculate the intrinsic value? So in the whale investor course, I'll teach you how to do it manually. Manually. Using the intrinsic value calculator here. Okay, so you can download this calculator once you take the course today. And then in the course, I'll teach you exactly how to key in all these numbers. You can get this for free on any website like Yahoo Finance or Reuters, right? Key in all these numbers and it will calculate the intrinsic value, which is about 209 right now. Okay? So you can do it manually, but you can also use Stock Oracle. And with Stock Oracle, it will do it automatically for you. Ta-da! There you go. Okay? And you can see that at 185, is it still undervalued? Yes or no? It is still undervalued, right? So I say Google is still undervalued. Okay. Now, if you look at the chart, for example, let me show the chart of Alphabet. All right. Now, again, check it out. Wave up, wave down, 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 wave up, wave down. Do we buy after wave up or wave down? Oh, sorry, I'm looking at ASN now. Sorry, wrong. Okay. My bad. Okay, there we are. Right. Wave up, wave down, 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 wave up, wave down. By the way, in the course, you will learn how to use all these moving averages. Notice that on a small wave down, wave down, wave down, wave down, it hits the red line. Can you see it hits the red line? The red dotted line is called the 20 exponential moving average. So during a small correction, it bounces off the red line, bounce off the red line. But in a bear market, it bounces off the blue line, the 50 moving average. Can you see? Toing. You see? Toing. And then recently, another big bear market, well, not really a bear market, big correction. You see, it toing here, toing. Now it's going up. So right now, it is on the way back up here, right? So it's halfway. So I would say here can still buy for me, but we bought a lot here. We bought a lot here. We bought a lot here, right? Because right now it's on the way up already, right? Okay, so that is alphabet. Now, how many of you have read in the media that they tell you, oh, now the US stock market is in a bubble, it's too expensive, everything, the US stock's too expensive? How many of you have heard people say that? So is it true? Well, let's take a look at some numbers. So first of all, why do some people say that the stock market is expensive? Because they are looking at what we call the PE ratio of the market, right? The price to earnings ratio. And if you look at the current price to earnings ratio, we call it the forward PE. So it's the share price divided by the projected 12 months earnings. Okay. The current PE ratio is 22 times. Now, is that high or low? Is 22 times high or low? Well, one thing people do is they compare it to the past, all right? So you can see that over the last 5 years, the average PE ratio was 19.9. And over the last 10 years, the average PE was 18.4. So at 22, it looks expensive because it is above the 10-year and 5-year average. Can you see that? Okay. Now, for those of you who have taken my courses or you watch my YouTube videos, you know that PE ratio is not a reliable indicator. It's not a reliable indicator. Why? Why is it not reliable? Because it doesn't take into account the growth of the earnings. It doesn't take into account the growth of the earnings. Listen very carefully. A company with a low PE ratio could be very expensive if the earnings are not growing. Like Intel. Intel, the PE is very low, right? At one time, but the earnings are not growing. So although the PE is low, but Intel is not cheap. But Nvidia, when I bought Nvidia in 2022, the PE ratio was 60 times PE. People say, oh, it's so expensive, 60 times. No, it was cheap. Why? Because the earnings were growing at 50%. So if the earnings growth is high, even a PE of 20 and 30 is cheap. So PE ratio by itself is meaningless unless you know what is the growth of the earnings. So instead of looking at PE ratio, we should instead look at what we call PEG ratio. Okay, or PEG ratio. Please write this down. PEG ratio. This is the more accurate model. So PE ratio is the PE divided by the earnings growth rate. And if you look at the PEG ratio of the market today, it is at about 1.4 times, slightly above 1.4 something. So is this very high? Not really. You can see what happened in 2023. It was at, the PEG was at 2. In 2020, it was at 2.4, right? Here was 1.7. Here was 1.6. And many times in history, it was a lot higher. So if you compare today with the past, it's not as high. So you can't compare today's PE ratio with the past. You know why? Because companies today are growing their profits much faster than in the past. Why? Can anyone explain why? Why are companies today growing their profits faster than 10, 20 years ago? Why? What's the reason? Because of productivity generated by AI. That's right. So you can't compare apple to apple. Okay. Now, but like I told you, the best way to value the market is to look at the individual companies. The index has 500 companies. And, and if you actually do an intrinsic value calculation for each of the 500 companies, you find that, yes, some of them are very expensive, but not all. There are still companies that are cheap right now. Okay. So let me show you this table. In the whole market today, out of 500 companies, 30% of them, okay, 30% of them are very overvalued. So that means they are selling more than 20% above their intrinsic value. Okay, you understand so far? They're selling more than 20% above their intrinsic value. And about 12.4% of companies are overvalued by more than 10%. 32% of companies are fairly priced. They are selling within plus minus 10% of the intrinsic value. And we've got 10% of companies that are undervalued and 14% that are very undervalued. So if you know how to search, you can still find good deals in the market today. The very undervalued, the undervalued, and the fairly valued. Okay? Would you like to know what are some of these companies? So because you took the time to come down today, I shall show you. And by the way, we update this for our members every few months. So if you want, you can take a picture of it. This is as of now. And of course, this changes all the time, right? Okay, there we are. So you can see these are the very expensive companies in the market. Over here, these are very expensive. Over here, this one here. So they are selling more than 20% above the intrinsic value, like Palantir, like Nvidia, like Netflix. Okay. And then you have got companies that are overvalued by 10 to 20%. All right. These are some of the companies over here. And companies that are fairly priced over here. Companies that are undervalued are over here. And very cheap are here. Okay. Now, just because these companies are very cheap, does it mean it's a good buy? Does it mean it's a good buy? No, because cheap crap is still crap. So don't buy a stock just because it is cheap. You only buy high quality stocks when they're cheap. So it must be high quality. So let me give you a few examples, right? These are the ones which are not high quality. Even though they're cheap, I won't touch them. Companies like Kraft Heinz, KFC, companies like Enphase Energy, like Walgreens, like Ford, like Las Vegas Sands. These are not high quality. How would you know? Again, you can use Stock Oracle to make your life very easy. Let's look at Stock Oracle. Let's put some of them in. First is Kraft Heinz, KHC. So you can see Kraft Heinz, the predictability ranking low, profit ranking low, low growth, weak mode, strong financial strength, and cheap, right? So it is cheap, it's got a strong balance sheet, but the rest are all low, it's not high quality, right? And you can see there's also no mode, right? And so although it's cheap, but I wouldn't touch it personally, right? You click on the VMI, you calculate the 7 steps here. financials may not pass, no mode, may not pass. You go through all the 7 steps here. Okay. By the way, if you go to intrinsic value here, it will show you all the different ways that it can calculate the intrinsic value. And you also give you the Oracle value. Oracle value is our own proprietary algorithm to use the best valuation method for this stock. Okay. So that's Kraft Heinz. How about Walgreens? Let's look at Walgreens here. Again, this is half price, right? The intrinsic value $22, selling at half price. But look at that. Predictability low, profit low, growth low, weak mode, weak strength, only cheap. This is what I call cheap crap is real crap. Okay. What's the other one that I looked at just now? Let's take a look. Ford, right? Ford will make cars, right? Yeah. So again, you can see Ford is cheap. Now, Ford is not that bad actually, right? Predictability medium, profitability medium, growth is high, mode is weak, financial strength. Okay, so Ford is not that bad, right? It's not that bad, but it's not great, right? The thing is no mode. If no mode, I won't really touch it. Okay, M phase. Enphase is also not that bad, but it's not great, right? Again, medium predictability, medium profitability, low growth, medium mode, medium financial strength, but it's very cheap right now. But if you look at the mode, which is the most important thing, let me just show you the mode here, right? Yeah, see, no mode, 4 of 10. Okay. How about Airbnb? Okay, now I can't give you all your requests. If not, I'll be here doing this forever. But don't worry, once you get Stock Oracle, all right, you can do it yourself. Airbnb is not bad, right? High predictability, high profitability, high growth, medium mode, high financial strength, and it is undervalued. So Airbnb is not bad, actually. It's actually not bad. Uh, but if you look at the mode score, let me look at the mode score right here. The most score is 6 out of 10. Okay, it's still okay, right? It's still not bad, right? But I prefer to buy, 7, 8, 9 out of 10. They'll be better. Okay. So what are some strong companies that are undervalued right now? What are some strong companies? So some strong companies would be Accenture, right? Accenture is undervalued, right? Copart, Salesforce, Google, okay, United Health. Okay, so these are our strong companies. So again, let's put it into Stock Oracle. We've got Accenture, and Accenture is undervalued, as you can see. All right, intrinsic value 325. Right now, it's undervalued. Predictability high, profitability high, growth medium, strong mode, strong financial strength, undervalued. So not bad, right? Pretty good. Accenture is pretty good. Copart, I have been recently buying Copart. So Copart is a good example. Share price drop, 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 drop. But the company is actually doing pretty well, right? High predictability, mid profitability, mid growth, high mode, high strength, right? And it's undervalued, right? What's the other one again? United Health. United Health. United Health right now is being hated. Pui. Okay, it's being hated, right? And you can see high predictability, high profitability. Now the growth is drop, but to me this is temporary, right? It will rebound, right, in the next 1 2 years, right? Mode, medium, strength, high, valuation very cheap right now. Okay. Novo Nordisk also very high, right? Business is actually doing pretty well, but the share price getting whacked because a lot of the healthcare stocks are being hated right now. So when you buy a business that is a very good business, but the stock is being hated, then you get a very good mispricing. All right. Okay, so yeah, don't worry, guys. You can get Stock Oracle today, and we have a special bundle promotion where you can get it at a very good deal, and you can go and do all this yourself, right? And can make your own decisions, right? So does this make your life very easy? Very easy, right? Yeah. Okay. So let me summarize what you're going to learn in the whale investor course, the value momentum investment course. Number one is you're going to learn how to identify the fundamentally strongest companies in the world. Right? How do you find the best companies in the US, in China, India, all around the world? Now, I'm going to tell you that Stock Oracle for now is only for US listed stocks. Okay, Stock Oracle is only for US listed stocks. So when you're analyzing stocks that are not listed in the US, then you have to use the manual method, which you will learn in the course. So in the course, you will learn the manual method where you don't need Stock Oracle. You can do it manually. Takes you a couple of minutes, but for Stock Oracle, right now, only for US listed stocks. Now, however, like for example, Alibaba is a China company, right? But can you use Stock Oracle to analyze Alibaba? Can you use Stock Oracle to analyze Alibaba? Yes, because although Alibaba is a China stock, it has a US listing, so you can also use Stock Oracle to analyze Alibaba. DBS Bank. Now, DBS Bank is a Singapore company, right? But does DBS Bank have a US listing as well? Yes, DBS also is listed in the US market. So you can actually also analyze DBS Bank. Okay, you can also analyze DBS Bank. So there are many stocks that are Singapore, China, but they are listed in the US. You can also use Stock Oracle, right? But it must be listed in the US. Okay. So that's the first thing you're going to learn. Number two, you're going to learn how to calculate the intrinsic value, okay, using the manual method, or you can use Stock Oracle. It's up to you. You can use both methods as well. And you learn exactly when I start buying, when it's undervalued. Number three, you will learn how to build a resilient, bulletproof, low risk, diversified portfolio. Again, minimum how many stocks? Minimum how many stocks? At least 8 to 10 stocks, right? And step four, you learn exactly when to sell. What are my selling rules? When do I sell a stock and reinvest in a better company? Okay. Yeah, so I'm coming to the end of the webinar actually. So I'm gonna share with you what's the crazy offer that we have, which is over 60% discount and a very special bundle where you're gonna get everything. You're gonna get Stock Oracle, UIP, and the whale course, all for a super crazy price only for this retail rebellion event, right? So again, I'm very proud to say that my students over the many years, they willingly share their results. People like Tony said, "Hello, Sifu Adam. I'm Tony, not from Vietnam. I'm very happy because my investment results in the US market in 2023 once again exceeded my expectations." And he was up 131%, right? And he said UIP, with its combination of long-term investment and trading options, is one of my best investments during the past 3 years. People like Adrian, very grateful to Adam, YY, Richard, and the team. Okay, invested in the VMI course this February, started to clean up and revamp my portfolio in late March, and now I'm here feeling surreal about the results, up 49%. And all these are so-called the dumb retail investors, so-called dumb, but no more dumb. Now they're smarter than the professionals. People like Huan Shin, I'm Malaysian, 26 years old, started investing and options trading a few years back because my uncle who took your course advised me to study your YouTube video each day. And again, this guy, 76% return. All new. And people ask me, of all the students I've taught over the years, who am I the most proud of? And I would have to say it's my own kids, right? So that's my wife. This is my younger daughter. She's 19. My older one, she's 21. And I actually started getting them interested in investing in business since they were 12. But only when they reached 18 years old, they opened their account with Interactive Brokers. And I gave them $5,000 each as an initial funding. And I told them that from now on, you put in your own funds if you want to, and you manage your own money, right? So I'm very proud that, by the way, the two of them are studying full time, but my younger one has her own business already while she's studying. And she also works part time for other companies. My elder one is also working as an intern, and all the money they make, most of the money, they actually put it into their brokerage account. And I didn't tell them to do it, they did it on their own, right? And I'm very proud that last year was the first time they were willing to share their accounts publicly, right? So I got 24.8% last year. My elder daughter, who's 21, she got 29%. She said, Dad, I beat you now, right? I said, great. And then my younger daughter got 20%, a bit disappointed. I said, don't worry, it's your second year, right? But the thing I'm the most proud of is not the fact that they can get higher returns than me, right? Which is great, right? But the most important thing is that they learn how to save money. They learn the value of money and they learn how to manage their money themselves. Last time, my greatest fear is that if I die or when I die and they inherit all my money, they will squander it away. They get cheated by people, they get scammed by someone. That was my greatest fear, you know. But now I know that they know how to manage money, they know how to invest. And even if I don't leave them anything, it doesn't matter, right? With their own skills that they have today and the own money that they make themselves, they will they will be worth millions and millions of dollars, right? Now they're only 19 and 21, and they are able to get the same result as me now when I'm 51. So imagine when they are in their 40s, when they are in their 50s, they'll be worth at least 50 to $100 million easily. Okay. And to me, I find that the greatest gift we can give our children is not inheritance. Because you give them money, they can squander it. Right? They can spend it all away. All right. Or a university degree is important, but everyone has it nowadays. What's the age? And nowadays, with AI taking over jobs, even with a degree now, entry-level jobs are being replaced by AI. So yes, even I have got this fear. Can my two daughters even get a job when they graduate? Or will all the jobs be taken by I don't know, right? But at least now I know that they have the skill to make money in the market. I tell my two daughters, go and find job, but work for fun. I say work for fun because your money, your millions will be made in the market, not in your job. All right. And if you have children, teach this to them. Please don't depend on a job to make your money. You have to depend on the market. All right. Because no one can take away this from you. Once you learn this skill of how to trade, how to invest, no one can take this away from you. All right. So people like Adnan, very cute. He got so inspired. He say, Adam, I invest for my son, 3 years old. Okay. Right? This is my son's account who's 3 years old. Both account up 30%. Well, of course, he has to do it for the son. The son 3 years old can't do it himself, right? Okay, so do you think that right now is a good time to invest? People say, oh, right now there's so much uncertainty. Trump is crazy with his tariffs, and the market has gone up so much, it rebounded. Is it too late? Do you think it's a good time to invest? Okay. So, first of all, let me just say that for the rest of the year, I'm actually quite optimistic for the rest of the year and even next year. There are a few tailwinds that will support the market. Okay. Number one is Trump's tax cuts. So, as you know, Trump is confirming the big tax cuts for the personal income tax, and corporate taxes will remain very low, and there's a lot of deregulation. So this will allow a 4 to 5% boost in earnings growth for the companies. Number two is the Federal Reserve. They are looking to cut interest rates, right? Once or twice a year. Once or twice by this year and more the next year. So this would be, again, bullish for stocks. Number three, there's currently $7.4 trillion of cash parked in money market funds. Okay, so a lot of people are still holding cash on the sidelines. Once the interest rates fall and the interest they get from the money market funds, from the fixed deposit, the time deposit drops, they will get out and they will put it more into the market. So there's 7.4 trillion of money yet to come into the market. Number four, as you guys know, the US dollar has been very weak this year. Okay. And that is actually very good for US stocks. Why? Because think about it. Many of the multinational companies like Amazon, Microsoft, they make money overseas and they bring it back to the US, right? So the weak US dollar, what happens? With a weak US dollar, the money they make overseas will translate into more US dollars. So a weak US dollar actually increases the revenue and the profits of these MNCs. Okay. But if you ask me, is the US dollar going lower from here? I don't think so. If you look at the long-term chart, the US dollar looks like it is near a bottom and is beginning to reverse back up. Okay. And the other good thing is lower oil prices. So the lower oil price, oil has been coming down. So the lower oil price is offsetting the potential increase in inflation from the tariffs. So it's a good offset over there. The tax cuts will also offset a lot of the increase in tariffs for the companies, right? But finally, the main thing that is driving the market higher is earnings. Companies are reporting stronger profits because of productivity growth from AI. As you now know, we have moved from AI chatbots to AI agents. And very soon, autonomous driving and robots. And all this will make companies more productive. You can see that the profit margin of the companies have doubled in the last 20 years. And with AI, it will keep going up. So companies' profits will keep going up, going up, going up. They will make more money and that will drive the market higher. Okay. Now, in my past webinars, I've talked about this many times, but I need to say it again because this is the main driver of stocks for the next 5 to 10 years. Okay. If you look at the economy and the market over many years, it's divided into innovation waves. Write this down, innovation waves. An innovation wave is a period of time where one innovation or several innovations will transform businesses, will create new wealth and transform our lives. So for example, the last wave was the fifth wave. The fifth wave lasted 30 years, from 1990 to 2020. What was invented in the fifth wave? We had the invention of software, started by Microsoft, right? Bill Gates, MS-DOS, then Windows, and then iOS, right? The invention of the internet, then invention of the mobile internet, and then social media, and then cloud computing. Now, let me ask you this question, guys. Has software changed your life? Has software changed the way you work? Has it changed the way you play? Yes. Right? Has the internet changed your life? Can you imagine now your life without internet? Can you imagine now your business without internet? You can't imagine, right? Okay. Has social media, has cloud computing changed your business, changed your life? Yes. So because of these innovations, it created companies like Netflix. That's why today you've got Netflix. It created companies like Booking.com, Agoda, online travel, right? It created Facebook, Instagram, TikTok, right? Created Google, transformed Apple, transformed Microsoft. So this has allowed the S&P 500 to gain 1,950%. over 30 years. This is despite the two big crashes. Despite the two crashes. There's a 10% growth in your money. That is if you don't use your brain. Now, for me, because I only pick good companies, I only pick the top 1% of companies, I was compounding my wealth between 20 to 40% a year. So I make my millions in the fifth wave already. I know some of you have already made your millions in the fifth wave. But how many of you, honestly, you missed the fifth wave? Either because you were too young to invest or you did not know how to invest. How many of you missed the fifth wave? Now, if you missed the fifth wave, the good news is that now we're in the what? We are now in the sixth wave. And if you think the fifth wave was revolutionary, it is nothing compared to the sixth wave. The sixth wave, in my opinion, it'll be 10 times stronger than the fifth wave in terms of the economic growth potential, in terms of corporate earnings growth, and stock market returns. So I am very optimistic of the next 5 to 10 years. I believe the next 5 to 10 years, the stock market is going to generate more wealth than the last 30 years. Why? Because of the AI revolution, robotics, and the Internet of Things. But you have to know what to buy. You cannot just buy any AI stock because 99% of AI stocks will go to zero. They are all hype. But it's the 1% that actually make money that people use every single day. The AI stocks or the cybersecurity stocks or the healthcare stocks. This is what is going to create explosive wealth. So if you want to learn how to capitalize on the sixth wave, then you got to educate yourself. You got to learn this stuff. You cannot leave it to chance. Does it make sense, guys? Okay, so let's get down to it. How many of you currently still face some of these frustrations where sometimes you just don't know what to buy? Where you don't even know how to start an account. Like, how do I open an account with a broker, right? Or you bought a losing stock, or you bought it at the wrong time, and you sold it at the wrong time, or you bet everything on one stock and you lost it all. Okay, or you panic during market crashes and you get out, but you don't know how to get back in. Or you got years and years of inconsistent profits or losses. If you have all these frustrations, you are not alone. Majority of retail investors who are not trained, who are not educated, they have these problems. Okay, let me ask you this question. Is investing risky? Investing is risky if you don't know what you're doing. Everything in life is risky if you don't know what you're doing. Getting married is risky if you don't know who to marry, right? Swimming is risky if you never learn to swim, you jump in the water, you will drown. Driving is risky if you never learn how to drive. You try to drive down the expressway, of course it's risky. You're going to get in an accident. Same thing with investing. If you don't learn how to invest, you try to do it yourself, of course it's risky. Of course you're going to get into a bad financial accident and drown financially. But if you learn how to drive, you go for driving lessons, you learn the traffic rules, driving is relatively safe. If you learn how to swim, swimming is no longer risky. Same thing. When you learn the rules of how to invest intelligently, you learn the rules of how to invest safely. Like what I've showed you, then investing becomes what? Safe. And investing gets you to where you want to go a lot faster than leaving your money and getting the 2% interest rate in the bank. You get the point? So risk comes from not knowing what you are doing. Risk comes from incompetence. If you know what you're doing, it is no longer risky. That's why to me, I got $19 million in the stock market. People say, Adam, how do you sleep at night with all the bad news? I say, to me, the $19 million has no risk. Has no risk. My 19 million has no risk. Yes, the market can go up and down in the short term, but I know that my 19 million will become 40, 50, 100 million very quickly. I know. 100% I know. Because I know what the hell I'm doing, all right? So how do you consistently, or how do you become a consistently profitable investor? So my team have created a new bundle called the Investor Fast Track Mentorship. All right, it's called the Investor Fast Track Mentorship. It's the simplest and fastest way to shortcut your success to become a profitable investor. And it consists of three things: the whale investor course, the stock oracle software, and the ultimate investor's playbook. So let me run through it briefly, right? So first, the whale investor course, this is a course total 12 lessons. This course is pre-recorded and is updated regularly. So this course is like Netflix. You can watch anytime, you can watch anywhere, as many times as you like. It's a lifetime access to this course. And the materials are updated regularly, right? So it's a lifetime access to the whale investor course, where you're going to learn all the basics of how the stock market works, how to invest in ETFs. Now, I'm not going to read all the details. You can read it later on the website. When you enroll, you can read all the details. You're going to learn what are the key steps to profitable investing. You're going to learn all about fundamental analysis, how to identify great businesses, the top 1%, the tennis ball companies, the best in China, the best in Singapore, the best in the US, the best in India. It's the same formula. Then you will learn about valuation. You learn how to calculate the intrinsic value of DBS Bank, of Nvidia, of Apple, to know, is it expensive or cheap? Don't guess. It is all in the numbers. Then you will learn technical analysis, how to read the chart patterns. Is it an uptrend? Is it a downtrend? Is it a wave down? Is it a support level? How do we optimize our entries? And then number 7, you will learn to put everything together in my 7-step checklist. So once the stock passes all the steps, you know that is a great business to buy, right? Then how to build a winning portfolio, how to find investment opportunities and when to sell, exit rules, how to use stock screeners to find the best stocks, how to manage your portfolio like a professional, and a big part of it is psychology. How to think like a winning investor. Okay, and how not to be affected by the news and the predictions and the noise in the market. How to choose the right stockbroker that meets your needs, and how to turbocharge your portfolio using options, right? So in the whale course, you will learn some of the basics of how to use options in your investment portfolio, right? Okay, so this is the whale investor course. It comes with the intrinsic value calculator, as well as portfolio tracker and dashboard. And of course, these are all my students over the years who have taken the course. People like Anthony from Australia, who got 51%, blew his mind. All right, people like Stefan, right, from Singapore. People like Oscar from Sweden. He said, "Hello, Adam. Buying this course was one of the best decisions I've made in my life. I just want to give a big thanks to you for the value that you provide." Right? Now, how much do you need to get started? Do you need a lot of money to start investing? In the US market, there's no minimum. You can buy one share or less than one share. So I tell people that even if you have a small amount of money to start investing, whether is it $500 or $1,000 or $2,000, start. Because if you don't start with small money will never grow into big money. You got to start somewhere. And the earlier you start, the earlier you're going to reach your financial target, whether is it 1 million, 2 million, 5 million, 10 million. The earlier you start, the more time your money can compound. Every day you delay, every month you delay, every year you delay, your money is losing value from inflation. And the longer and longer you push back your financial freedom. So I tell people, start as early as you can. The best time to start was 10 years ago. The second best time is now. Okay? People like Kedar from Nepal, right? He said, "Adam, I got 80% return after your course, but from 2011 to 2018, I lost everything. I lost 7 years. I wish I had known you that time." All my students always have the same complaint. that I didn't take your class earlier. They always say, I only wish I took it 5 to 10 years ago. But at least it's not too late now, right? People like Luke Suck said, I've made back all my losses in the last 20 years. Okay. Now, one reason why my students say they are so successful is not just the content, but is the community. We have got one of the biggest communities of investors in the world, where you'll be in my private chat group. I'll be in the chat group 7 days a week, over 16 hours a day. Any questions you ask, we're there to help you. We're there to share ideas with you. You got the idea for a stock, you share the idea, we give you feedback. We're there to encourage each other, especially during tough times when the market goes through big up and down. We're there to encourage and help each other. These are what my students have said. They said, VJ said, yes, seriously, I did not expect this kind of support from Adam. He answers everyone and it's a great online course, but the support we get in this community is matchless. I keep asking my friends to join the course as well. They say, Adam, I can't say enough. You're the best teacher in the whole world. I've been to many paid courses, but no one out there would take time after hours, whether weekend or weekday, to answer questions and steer us in the right direction as you do. Every dollar spent on your course is worth millions, right? People are Ronnie said, had I not belonged to this group, I could have been screwed big time. I wish I had enrolled earlier, right? They all say the same thing. I wish I enrolled earlier. They all say the same thing. Okay, let me just skip this too many. Okay, so the Whale Investor course, like I said, is a lifetime access and it's a on demand, which it means you can watch anytime, anywhere. Next, some people say, Adam, I take your course, I know how to invest, but I want to fully automate it so that I can analyze any stock in seconds and make decisions in minutes. So we have got our stock oracle. Okay, so it's stock oracle, as you could see just now, put any stock, it does everything for you in seconds. So you can make very quick decisions. Now, stock oracle Pro Plus, you'll get the Pro Plus, which is a 1 year access. And if you want to extend it later to more, you can always do so at a very low renewal rate, right? Then some people say, I want to know exactly what Adam is buying every day. I want to know what Adam is selling every day. I want to know all his option trades. I want to look at all of Adam's research. I want to leverage on his portfolio and his watch list. So if you want to know exactly what I'm watching, you want to look at my portfolio every month, you want to see what I'm buying and selling, then we have got the Ultimate Investors Playbook, the UIP. Okay, so this is where you get to track my portfolio, track my watch list, and get my daily buy and sell notifications. Not that I'm recommending you to buy. I don't recommend you to buy or sell. I just show you what I'm buying and selling. I show you my research, but you make your own decision, okay, based on your own financial needs and all that, right? So I'll make it very clear. This is not me recommending you to buy and sell. It's showing you what I am buying and selling every day, okay? So you get monthly deep dive research reports where all the stocks that I own, you get all my research. All my research notes are all there. Okay. And I do a monthly portfolio review. You get to see exactly all the stocks I own, my portfolio allocation, how much I intend to buy in the next few months. Okay. And these are my notifications. Like, for example, I say I added Evolution at 109, right? I added sold CME, I swapped into Monster, right? So these are my daily notifications, exactly what I'm buying and selling. Recently sold all my Lulu for a very good profit. Okay. This guy Matthew says, I'd like to share my result, 79% return, my first year progress. I renewed now second year of UIP program, will continue to support UIP besides investing and trading options. My option premium collected is 7,000 for September. So these are all my notifications, all right? I'm up 42%. buying only UIP stocks, which is double the S&P 500. This is Roman, right? And of course, we got Venki, who is in the chat group. I saw his name there. And he took this course at 80 years old. 80 years old, right? And now I think he's 83 or 84, all right? And he flew all the way down from Texas to Singapore for 1 day to thank me and to meet my team and flew back, right? And I think now he's 84 years old. Amazing guy. And now he helps to manage money for his children, who are his adult children, obviously. Okay. Okay, so the UIP is a 1 year access. Okay. And this is the usual retail price. The whale investor cost usually retails at 1899 US. The Stock Oracle Pro Plus at 497 US. Second year renewal at 249 US. Um, the UIP retails at 1009 US. Second year renewal at 1140 US. Okay. If you want to renew the second year, you don't have to, right? If you want to, right? So the total retail price of what you're getting for this entire mentorship fast track is 4296 US dollars. 4296 US dollars. Now, for today's retail rebellion, you're getting a special three bonuses. You get my monthly investment newsletter. You get additional 2 months subscription to UIP, which means altogether 14 months subscription only for this promotion. And you get extra 1 month subscription to Stock Oracle. So Stock Oracle, 13 months, UIP, 14 months, will cost unlimited lifetime access. It's more than enough for you to gain all these skills. Okay. So what's the crazy price today? Right now, when you enroll right now, 60% off. So your tuition fee for everything I mentioned is only 1718.40 US dollars. $1,718 for a 0.40, right? This is a steal. Okay, so you'll never see this price again. I can tell you that, right? If you don't grab it now, you will knock your head against the wall 10 times later on because the kind of value you're getting. So to grab this offer, you can scan the QR code over here or click on the link in the Zoom chat, and you can grab this offer at 1,700 plus US dollars. Now, for those of you who are already in UIP, you're already having my whale investor course. You want to buy Stock Oracle separately? Yes, you can do that as well. You can go to my website, piranhaprofits.com, and the a la carte. You can buy them a la carte, but of course, a la carte will be a lot higher price, right? Now, you want to get this bundle, then you can grab this special offer right here, right now. Okay, fast action bonus. For those of you who enroll in the next 15 minutes, you will get a special live stock investing jumpstart workshop worth $300. And this is conducted by our investment coach, YY, who also has got a fantastic track record. In fact, he also manages my company's investment account. All right. And I'm very proud to say that his returns are actually higher than me. Okay, he actually got higher returns than me, right? It's a 3 hour online session, and you get this worth $300 only if you enroll in the first 15 minutes. Okay, so again, that's 1,700 US dollars, and you can grab it right here, right now. So I'll give you a chance to enroll now, and in a few minutes, I'll do a Q&A. All right, I'll do a Q&A in a few minutes. So just hang on as you guys enroll. I'll be back in about a minute to do the Q&A. Okay. All right. So I'm gonna do the Q&A. All right. So let me do my best to answer some of the questions that you guys have. All right. But before I do a Q&A, let me just share one more important thing with you guys. Right. So like I said earlier on, is investing risky? Yes, if you don't know what you're doing. Right. But if you know what you're doing, investing is no longer risky. Investing becomes the safest option. In fact, I tell people that you know what is the greatest risk? You know what is the greatest risk of all for you and for your family financially? The greatest risk is not investing. Is not investing. That's the greatest risk. Why? Because if you don't invest, then 20, 30 years from now, when you can't work anymore or you want to retire, you find that your wealth has not grown enough to be able to finance your lifestyle, right? How many of you know people who are now in their 60s, 70s, and 80s, and they save hard all their life, but because they did not know how to grow their money enough, they find that in their 60s, 70s, and 80s, they thought they have enough, but they find that they don't have enough because everything has become 2 to 3 times more expensive. And they're struggling financially, right? So you don't want that to be the case 10, 20, 30 years from now, right? Inflation is crazy. I mean, if you think about it, a movie ticket 20 years ago was $5, right? Today, a movie ticket is $15, $16, right? It's 3 times, okay? So people who take this course is not because they want to be super duper rich, not all of them, okay? But this course is for everyone. If you're someone who works very hard in your job and you want to make sure that you want to protect what you have made, you want to protect it from inflation, you want to protect it from making bad decisions, you want to protect it by being scammed by people, all right? Then this will help you to get that, to make sure that again, 10, 20, 30 years from now, when you don't want to work anymore or you can't work anymore, you have enough wealth to live comfortably in this very expensive society that we're in, right? But some of you may say, Adam, I'm in my 20s. I'm in my 30s. Do I have to worry about that? Yes. I worry for my own children. I'm sure you can see the writing on the wall with AI. AI is replacing a lot of entry-level jobs now, white-collar jobs, right? And Microsoft laying off 9,000 employees. DBS Bank is cutting 4,000 jobs in the next 3 years. IBM is laying off 8,000 employees. AI is going to replace many, many workers. We can't stop it. We can't stop it. It is happening whether we like it or not, right? So I tell people that if you want to survive the AI revolution, there are 2 things you must do. Number one, you have to learn to use AI in your job. If you don't learn how to use AI in your job, you will be soon replaced by someone else who knows how to use AI in their job. People who don't know how to use AI in the next few years are like people who don't know how to use the internet, because AI will be bigger than the internet. All right. So that's the first thing. So you must learn how to use AI in your job. Number two, like it or not, AI will make the rich richer and the poor poorer. Okay. And like it or not, it's your choice whether you want to be the rich or the poor. Okay. So you have to own businesses that are at the forefront of the AI revolution. Because in the near future, all your Grab, Uber drivers will be gone. You know that, right? You'll all be replaced by robo-taxi. Who will make all the money? Is the AI companies, the the autonomous robots company. So you got to own these companies. Okay. In the near future, humanoid robots will take over many, many jobs. Okay. You have to own the companies that make these robots, that own the chips, that own the software. Okay. So we have to set ourselves up so that when the AI revolution is in its fifth to 10 year, we are benefiting from it. We are getting rich from it, and we are not the majority who will be wiped out from it. So to me, learning to invest is not something good to have. It's not something good to do. It is a must. We have no choice. We have to invest in order to beat inflation. We have to invest to make sure that we have enough wealth to last the next 10, 20, 30 years. All right. So since we have no choice but to invest, why not learn how to do it safely? Why not learn how to do it properly? Right? Because if we don't, then it's something very risky. Okay. So that was my little sermon, if you will. And let me just see if what are the questions that came in. Let me just do my best to answer some of the questions. Let's see. Okay. I have to put on my glasses. I can't read this. Okay. Now some questions not relevant. I'll have to skip it, right? Okay. So what I think about some of these companies. Now, I won't give specific like stock tips and all that, right? Because that one you can use Stock Oracle to do your own analysis. You come to the course, you learn how to analyze a great business. But I'll answer questions that are more macro. Okay, why not invest in a Nasdaq 100? Yes, you can. You can invest in a Nasdaq 100 ETF. Of course, you can. Right? That's called the QQQ or the CNDX. Um, Okay, someone is asking, do I only buy during the 10% decline and save my money during the normal trading days? Because I do DC dollar cost averaging every month at rate days, but often find myself out of money during the big crash. I would say do a combination of both, right? You don't always have to wait for the big crash to buy, right? So what you can do is, again, look at the individual companies. And as long as it's below the intrinsic value and it retraces to a support level, I would buy a bit first. So always buy in tranches, buy a bit, slowly buy in. Okay. So at the start of every year, I always set aside a certain amount of money I want to use to invest for the whole year. And I never use all my bullets in the first month. I never use all my bullets in the first 6 months. I will spread out my cash so that every month I've got a little bit to buy, a little bit to buy. So I slowly average in, right? And of course, there are certain months when the market goes up a lot and nothing is, well, the companies I want to buy are not cheap, then I don't buy. All right. So those months I don't buy anything. Then those months when the price drops below the intrinsic value, then I start to accumulate. So it's not that I will buy every month. No. All right. I only buy when it is undervalued. Okay, so some people are saying if I buy a great business when it's cheap, but the price keeps going down, do I keep buying some more? The answer is what I do is I'll buy until I've got a full position. Once I have a full position, I will not add more. So, what is a full position? It depends on how many stocks you have in your portfolio. So, if your portfolio has got 10 stocks, okay, if you plan to have 10 stocks, then each stock should not have more than 10% allocation. If you decide to have 20 stocks in your portfolio, then each stock should have no more than 5% allocation. So never over allocate to one stock. Okay. Okay, what do I think about Lululemon? Well, I actually sold all my Lululemon at a very nice profit. And Lululemon is a good business. It is undervalued. But the reason I'm not buying back in is because I realized that retail stocks, retail like fashion companies, they are not as resilient in the future because once the fashion trend changes, then the business will not do well. And it's very hard to know and predict when the trend will change. Like last time, if you remember, there are many hot fashion brands. Um, I'm doing my best to recall one of them that was very hot last time. One of the very hot fashion brands. I can't recall. Anyway, so I mean, in the past, there have been certain hot fashion brands. Okay, and then once the Fed changes, the Fed FAD changes, then it's gone. So I'll be very careful with things like Lululemon because you know it's faddish in that way, right? LVMH, I would say, is more diversified because they own alcohol brands, they have got perfume brands, they got clothing brands, they got bags. So it's more diversified, right? What about my China stocks? I'm still holding my China stocks, by the way. All right, I'm still holding them. Because right now China is still in a bull market and a lot of them are still very cheap, like Alibaba, like Ping An Insurance. So I still think there's a lot of upside to China stocks in the short term at least. Okay. Singapore REITs are not as cheap as they were, but some of them are still reasonably priced. Okay. But I would focus more on the Singapore REITs that have more Singapore asset exposure. But a lot of them have rebounded quite a bit already. Okay, I've bought a couple of stocks over the last few years and it's never really profited. What's your advice on how to reset a portfolio? So I think what is important is to look at your current portfolio now and to check, are they all great businesses? If they are great, but the price has not reflected it, I would keep it. But if you find that the businesses that you have bought are not that great, they are not really making that consistent profits, then I'll get out. And then I'll take the money and replace it and reinvest in a great business. So you have to reshuffle to make sure that you only own the great companies with the strong moats that have a good potential of doing very well. Can the Williams indicator be used on specific stocks? Yep, you can. Someone's asking about quantum computing stocks. Now, the trouble with a lot of these quantum computing stocks is that they're not profitable. So a lot of their value is based on hype and hope, which I tend to avoid, right? I avoid companies that don't make money, right? Yeah, one day they could make a lot of money, they could change the world, but what if it doesn't? I'd rather invest in companies that are already proven money-making machines. Okay. How much money do I need to invest? Well, like I said, there's no minimum. Whether you're starting with $1,000, with 500, with 10,000, 100,000, start something, all right? And invest with money that you don't need to touch in the next 3 years or more, okay? Because you got to give it time to grow, you got to give it time to compound. People always want quick and fast money. I want to make quick money now, fast money now. And the trouble is that life is not so simple. If you want to make big money in the short term, it normally is not sustainable because you will go for those get rich quick stocks, for those hype stocks that can make a lot of money in the short term, but they can also collapse just as fast. Okay. So if you want to make quick money, then it's not investing, it is trading. Right. So trading, right? Alson will be coming next and he'll talk about trading short-term techniques on market price action manipulation techniques, right? So he'll show you another approach on how to make money through trading the 99% of more speculative stocks, okay?
Some people asking me about crypto. I don't touch crypto at all. I'm an old dinosaur. It's something I don't understand. I don't know how to value it. So I don't touch crypto. But if you want to learn about crypto, you can wait for Alson. Alson will be coming. He'll be talking about crypto. Alson has made over $10 million on crypto. In fact, more than that, right? But Alson is very clever because he already sold over $10 million of crypto and he bought two shop houses in Singapore. Okay, so he already took and run already. And well, of course, he's still in crypto now. He still trades a lot in crypto, but I always say that even if crypto goes to zero now, he doesn't care because he already cashed out 10 million and bought two shop houses already. So when you trade things like crypto and all that, you must know when to run. You can't stay for too long. You must take it, run, buy short house, buy good companies and all that, right? Because those are speculative. Those can drop to zero very, very fast, right? So you have to know when to get out. Whereas you buy a good company like Microsoft and Apple, these are companies where you can let it compound for the long term. So you must know the difference between investing and trading is very, very different, right? Okay, guys. So I hope all of you have taken advantage of the promotion. If you have not, this is the last time I'm going to flash this slide. Again, scan the QR code, click on the link. It's only 1,007 for the entire investor fast track mentorship. So grab it now. And if you're within the first 15 minutes, you get all the great bonuses. Remember to stay behind, eat your lunch at the same time, stay behind because you want to catch Alson Chu, who is a former proprietary trader who has made several $1 million for his firm and now for himself. And he specializes in price action manipulation, where he will show you how market makers manipulate the markets every day, how they scare investors to sell at the bottom and to get them to buy at the top. And how do you detect these price action patterns and profit alongside these manipulators? All right, and you show you how he applies it to stocks, to crypto, China stocks, Singapore stocks. So do catch him. He's coming on in a couple of minutes. So guys, thank you for joining me, and I'll see you tomorrow for my webinar tomorrow on how I trade options. Okay, so I'll see you guys tomorrow. In the meantime, stay for Alson's webinar, and I do hope that you've enrolled in the fast track mentorship. See you soon.